conference. My name is Thembisa Magele. I'm the head of communications at the FSCA and your program director over the next 2 days. So for this conference, today and tomorrow, we've chosen the theme, Inspiring Trust, Evolutions in Financial Conduct Regulation. We were very specific about what theme we wanted this conference to really capture. And trust was what reverberated all around. The reason for that is because whether you're talking about the relationship between us as the regulatory authorities and the industry that we supervise, or you're talking about the financial institutions and the relationship they have with their customers or amongst each other, what underpins all of that is trust. And so what we are hoping to do over the next 2 days is to foster more of that trust so that our industry can function even better. So before we start, some house rules. If you need to step out for any reason, if you need to take a call or you need to just step out, please could you kindly, if you are from the middle to the back end, could you kindly use the back entrance? If you are more towards the front, you're welcome to use this entrance here. The Wi-Fi password will be on the screen for most of the morning, and so if you need to use that, you're welcome to do so. And also just to let you know that we are streaming the event live on YouTube, on LinkedIn, and on X. I'm trying to show everybody that I'm with the times. It's X. I'm still with the Twitter brigade, so forgive me if I miss that one every now and again. But also, one of the things I wanted to just point out is for the online audience, you are welcome. Thank you for joining us. If you would like to take part or participate in any way, if you've got comments, if you've got questions during the proceedings, please could you send an email to events@fsca.co.za. Events@fsca.co.za for our online audience. On that note, bathrooms are out these doors across the hallway and to your left for your left, yes, for the ladies, to your right for the gentlemen. All right, I think that's everything in terms of house rules. Now on to the rest of our program. First up, I'm going to ask the Commissioner of the FSCA, Mr. Onati Kamlana, to officially welcome you, give his opening remarks, and also introduce our keynote speaker. Let's give him a hand.
Thank you very much, Thembisa, and good morning, everyone. Let's try again. Good morning, everyone. My name indeed is Unati Kamlana, and I am the Commissioner of the FSCA, have been the Commissioner of the FSCA for the past 3 years now. And really thank you very much for making the time and coming out here. I think it's a good turnout. It being our inaugural industry-wide conference, perhaps you should also congratulate yourselves for securing the invitation to the engagement. So well done. We are really looking forward to the engagement. We're really looking forward to the conversation over the next day and a half. This is very important to us. We usually send out a lot, whether it's notices or guidance and supervisory engagements. Maybe we say a lot too much all the time. It really is also helpful for us to sit back and listen and obtain the kind of feedback that we will be getting for sure from yourselves in the next day and a bit. So I wish to also extend a very special welcome to Mr. Liseja Khanyago, who is here. I don't think he needs any introduction. I'll talk about him a little bit later when he's going to come and deliver the keynote. All I'll say is that I used to work for him. 10 years, I think, I worked for him. And I think it was a bit of a challenge for him to appreciate that I am no longer within with the SARB, but he still maintains the title of former boss. But he is now the 10th governor of the South African Reserve Bank. That is the official situation between the two of us. Let me offer a few contextual remarks which are really intended to frame the conversations and discussions.
But now I can talk though, right?
And a half. All right, I think that was that was technology, deployment of technology. So I just wanted to offer a few contextual remarks to sort of frame the discussion over the next day and a bit, and also position the strategic importance of this engagement for the work program of the FSCA. If I would try and suggest perhaps, key phenomena which have characterized the state of the South African financial sector in recent times. And of course, I'm doing this applying the lens of a market conduct regulator. It's important for me to say that because I spent quite a bit of my career as a prudential regulator. So I'm applying the lens of a conduct regulator in articulating these issues. I think the first issue is the cost of living crisis. And I think a particular area of interest for us as the FSCA in terms of that is the increasing vulnerability of customers. And Governor, I'm not trying to put you on the spot here at all about the legal meeting that you will have towards the end of this month with the MPC. But the cost of living crisis is still very much with us, with very important implications, I think, around customer outcomes, given what we see as increasing vulnerability of consumers. So that's the first issue. The second issue is quite topical. Maybe this issue could have easily been the first issue, and that is the market integrity issue, the need for us to get ourselves off the FATF grey list and to do so urgently. We do have an agreed time frame with FATF in terms of the action plan, but I do think that this is certainly something that has been occupying our minds and certainly how we think about our work as the FSCA in the last 2 years. The third issue, I think, is an important structural issue. It's a structural change which is brought about by the impending implementation of the two-pot system. I think we have been focusing, as all of us should, on the implementation, which is now settled around 1 September. But I do think that there are important impact conversations that we've probably not yet had or have not actually given as much attention on those as we have getting ourselves ready for implementation. So I'll come back to this issue of two-pot and the sort of structural change that it represents in terms of how we think about retirement savings policy and outcomes. The last issue is probably the most important, given that it is the theme of this conference. And it is about building trust in the financial sector. And asking the question, really, which is, what is our assessment of where the sector stands in terms of its conduct, reputation? And how do we assess that? In an objective way, in a less defensive way, and of course we'll try to maybe have that conversation slightly above some of the specific scandals, for a lack of a better word. There's a lot of noise There's a lot of feedback that I think is important for the sector to be listening to. But let's have the conversation about where do we think we are? What progress is the sector making around becoming a sector with a strong reputation when it comes to conduct issues? And that includes a lot of things. That includes a lot of considerations, whether you are looking at innovation and technology, the impact of how technology is deployed, how we think about the efficiencies, but also who do we leave behind, and what can the sector do to make sure that we leave no one behind. And of course, our ability, by our I mean as a regulator, our ability to respond to these changes and ensure that even with the evolution and change of business models, that we are actually able to say treating customers fairly is still central to how financial institutions in South Africa are thinking about their relationships with customers. So all of these things, I think, talk to this issue and idea of trust and how we build trust. And of course, central to this, and I know this sounds like an obvious point, it's a tried point, but I'll make it anyway, the role and ability of leaders at the highest level in financial institutions to champion these issues. Issues around culture, governance, accountability, transparency, transformation. All of these things are very important and essential elements of how we build trust and how we contribute to good conduct. Now there's a longer list of things that we talk about and think about as the FSCA, but I'll just focus on these two for the purposes of these opening remarks. And of course, I'm looking forward very much later to be listening to you about how you think about these things in your respective businesses. So maybe a little bit on the cost of living crisis. So as I was saying earlier, the interest for us here is to think about and to understand better this concept of vulnerability and the fragility of households that we see, and I'm sure you see it clearer, of course, in your respective businesses, with many households struggling to cope with the rising cost of basic necessities. And how should the sector be thinking about this? And whether there is a need from a policy and a regulatory perspective to actually contribute in a much more definitive way a framework of thinking about the treatment of vulnerable customers. So that's the issue, and of course colleagues later will talk about this, and we'll be very happy to hear your views. Part of what is important, of course, and relevant for that thinking is the fact that, for example, South African households have very, very high levels of debt. And therefore, if you have a situation as we have in terms of monetary policy and interest rates being high, again, not putting the governor on the spot here, we know that interest rates are what they are because inflation is what it is. But it is us thinking through those issues and how they affect business models and how they affect the mandate of the FSCA and your responsibility around treating customers fairly. So that's the kind of conversation that we'd like to have. On the grey listing, as I was saying earlier, I guess maybe two messages here. The first one is that this is a collaborative effort. And it's a collaborative effort, firstly, within government, given that we need to deliver on the action plan, not just amongst financial sector regulators, but amongst other players and colleagues as well. Now, to say this, that some of you have been also on the receiving end of us delivering on the action plan. one of the things that we have to deliver on the action plan is the imposition of sufficiently dissuasive financial sanctions. That means fines, more fines, higher fines. So some of you have already received those letters, and I can also just say, to those that have not yet received the letters are in the mail, making their way to a letterbox next to you, close to you. So we're making progress as the FSCA, and tomorrow Treasury will be here to talk about, the overall progress that we're making as a country, but also specifically, where we need to be, given that the time frame, I think, is February 2025, and the reassessment is then shortly after that. But the message about this is that this is urgent. This is urgent for all of us to do what we must and to do what we can to get ourselves off the FATF grey list. On the two-port, just a few things. So as we know, historically, retirement funds have focused on long-term savings accumulation with really limited access before retirement. There's been, as you know, a lot of discussion and debate around the need to provide some kind of access, apart from people needing to resign, some kind of access to their retirement savings. I do think that, the focus has been on how we design this part, which is accessing savings. We do have a responsibility, I think, both us as a regulator, but as a sector as a whole, in providing complete information to members about the impact of that decision. I think in how these conversations have been had, one gets the impression that people must just access because it will be allowed. I don't think that is the kind of message we want to send. We want to say the system is changing, you'll be able to access, but to the extent that you can afford to not access retirement savings because they are for retirement, that is also okay. So that's one part, and it's about financial education. The second part, actually, which is not getting any kind of coverage at all in many of these conversations, is the compulsory preservation part of that reform package. It's quite important that as we interact with members, as we design and package financial information and financial education for members, that we actually start including this and elevate it to the same level, because it is an important structural change in terms of how we think about retirement savings in South Africa. So I thought I would mention this because I worry that there's just a lot of very pertinent information in understanding this reform in total, comprehensively, that we are maybe not yet making available to members. The next issue is the one I was mentioning earlier around trust. So I know this is potentially sensitive and controversial, but I do think that here, hopefully, we will have the kind of openness to have these discussions. Trust is an essential ingredient of something much more important that matters to all of us, which is confidence. And with confidence, we also are able to deliver on something much more important as well, which is stability, financial stability. So I'd really be interested in hearing what your view is on, what else can be done to enhance the levels of trust in the financial sector. I think all of us quite appreciate that many financial products are grudge purchases. It's not like you're very excited, you're buying this policy, but it's important that you have one. So whether you're thinking about savings, whether you're thinking about risk management around risk events in your life, and so on. And because of this, I think the sector has got a much higher responsibility compared to other parts of the economy to be considering that the sector be seen as trustworthy. And this is absolutely important for the work that we do. And I hope we'll be able to get some time to talk about this a little bit more today or tomorrow. And again, and I mentioned this earlier, and I do want to underscore this point, which is the role of leadership in championing the issues of good conduct in licensed financial institutions. I think all of us will agree that people deliver on things that they understand as clear priorities in organizations. If leadership does not make it clear that issues of conduct, good culture, and trust are important in how leadership assesses performance and people's contributions in their organizations, then these issues will just not get the kind of attention that they should. And there are terrible consequences that we've seen many, many times. Of course, I won't mention specific examples here, which just really flow directly from bad culture and really leadership not stepping up to where they should around championing good conduct in financial institutions. And this is something that we, between ourselves and the PA, we emphasize because it's important for both prudential outcomes and conduct outcomes. It's important for sustainability of businesses. Small, large, it's just an important issue. In terms of the work of the FSCA, I think it's important to mention this. Many people have asked in many engagements that we've had, so what has changed? What is changing? What is the difference? So we are now in Twin Peaks, but what has actually changed in terms of how you go about doing your work? One of the primary areas where you can really see difference in terms of the work of the FSCA is a deliberate move from a compliance focus, a rules focus, to an outcomes focus, a more proactive risk identification and risk mitigation focus. That's really the essential change that we see. Whether we can talk, and we will maybe later talk about our digital transformation strategy, how we will be obtaining data and how we'll be analyzing that data, how we package it for insights in terms of how we supervise and interact with the sector. All of that is informed by the fact that we have deliberately changed what the focus is. And that is really the expectation of Twin Peaks. One of the things that's important in terms of that is responsiveness. And there'll be a presentation later, for example, on our approach and licensing approach for crypto asset service providers. And this is us designing and being very deliberate about how do we bring within the regulatory net initiatives and developments that we categorize as responsible innovation. And therefore, I guess there needs to be a conversation about what we see as not so responsible innovation. And you'll be aware that around the world, there's still a lot of discussion and concern about the fact that there are still inherent risks at the product level that I think is very important from a financial education perspective to talk to. But I think it is still right strategically, we feel, that at the level of quality of advice and intermediation, that there be a formalization of, licensing and regulating these firms, given that we know the extent of financial customers who interact with these providers and who interact and have exposure to these products. We probably have things that we will get wrong, or there'll probably be risks that do materialize, and we'll learn from those and close those gaps. But I think a strategy to actually have a regulatory framework in place still delivers better on our mandate than the alternative. So I think let me leave it there. There will be an Exco dialogue just after the keynote address, and please feel free to ask questions, and we can begin to unpack some of these things, whatever is interesting to you. So we can to hear from you, as I was saying earlier, and I really encourage everyone to participate and to engage in the meaningful dialogues, well, hopefully meaningful dialogue over the next day and tomorrow. And now, ladies and gentlemen, it gives me great pleasure to introduce a respected leader in our economic leadership in the country, who is the current and the 10th governor of the South African Reserve Bank, who will deliver the keynote address for this conference. Please help me to welcome him to the stage, Mr. Lisetja Kganyago.
Thank you very much, Commissioner and Deputy Commissioners, ladies and gentlemen. Some things don't change, Commissioner. You work for me, you will always work for me. But thank you very much for inviting me to speak here today at this inaugural industry-wide FSCA conference. And I hope that one day the Prudential Authority of the South African Reserve Bank will find the courage to invite me to their industry one day. Today I'd like to talk to you about the relationship between market conduct and financial stability. And for those of you who think that compliance on conduct issues is expensive, try non-compliance and see how expensive non-compliance can be. And these conduct issues very fast, very quickly become prudential issues if you do not attend to them. As you know, these are the twin peaks of our new model for financial regulation that came into force in 2017. This was the same landmark reform that birthed the Financial Sector Conduct Authority as well as the Prudential Authority. The South African Reserve Bank, which incorporates the Prudential Authority, has ultimate responsibility for financial stability. At the same time, the Financial Sector Conduct Authority is the apex authority for market conduct. There is a clear separation. Our twin peak model has yet to fully mature. For instance, pension funds and collective investment schemes are expected to move to the PA only in April 2026. It is nonetheless a comparatively robust model, especially for a highly concentrated financial sector with a small number of large players, as well as the continuous development of financial technology. Still, even with a clear division of labor, the details of how we pursue financial stability and good conduct are more complex and sometimes confusing. For instance, if you go to the FSCA website, you will find a list of 5 strategic objectives. And number 1 is ensure the stability of financial markets. You might have thought that was the SAP's responsibility and not the FSCA's. But of course, to protect financial stability and to restore it when a crisis breaks out, the SAP does not operate in isolation. We rely on other institutions such as the National Treasury, the Financial Intelligence Center, the National Credit Regulator, and of course, the FSCA. Cooperation between these institutions is also institutionalized through the Financial Sector Oversight Committee, FSCA, and the Financial Sector Contingency Forum, the FSCF. Similarly, Twin Peaks clearly assigns market conduct issues in to FSCA, but that hardly means we at the SAP can ignore conduct issues. Indeed, as I shall argue in my talk to you this morning, financial stability and conduct issues are ultimately connected. A system rife with misconduct will also become unstable. Before I turn to our South African context and challenges, let me start by delving into global regulatory and conduct issues. The global narrative on financial regulation changed completely with the great financial crisis. Before 2008, finance was widely considered an industry where light touch regulation would free smart people to generate astonishing wealth. The narrative had the most traction in the advanced economies. Indeed, financial crises were often portrayed as things that happened in emerging markets, which could usually be blamed on governments. But, of course, the GFC was triggered by events on Wall Street, the very center of advanced economy finance, and the private sector was plainly guilty of excessive risk-taking and bad judgment. The lessons of that crisis ushered in totally new narratives on financial sector regulation. I say narratives because there were two: a technocratic version and what we can call a popular or even populist version. You don't like this one?
No, they say in the signal.
The technocratic part was about re-engineering finance to make another GFC impossible through changes like raising bank capital and intensifying supervision. Many people here are experts in this complex, jargon-heavy field. The popular story was quite different. People were so highly paid bankers bring the economy to its knees, causing extensive job losses and walking away with no jail time and no clawback of past bonuses. This made a lot of people angry, manifesting in protests like the Occupy Wall Street movement. The technocratic mindset and the populist mindset are very different, and the two usually uncomfortable in each other's company. Populists are often bored and uncomprehending in technocratic conversations, while technocrats usually flounder when they try and do politics. But the lesson we must take from this is that financial stability is not just an engineering problem. I do not think it is possible, at least in a democracy, to have a good policy regime for protecting financial stability if you do not also have an effective regime for regulating conduct. If people feel abused, tricked, or betrayed by the financial sector, they are not going to be interested in thoughtful, technocratic proposals for obscure variables like liquidity coverage ratios. Their elected representatives won't be interested either. The political discussion will center on moral outrage, and that will drain the oxygen out of technocratic debate. You can try and push along with the technocratic work, following global best practice and debating ratios. But sooner or later, the political and the technocratic worlds will need each other. You will get crises, and in crises, you really need people to work together across government, the private sector, and also civil society. If you get to that point and trust has been bent up by misconduct, good luck getting policy right. We live in difficult times, so the margin for error is small. There is a very clear upshift in geopolitical tensions in the world. Our headlines are full of war horrors. This is going to be a record year for elections, and some of these election results could be highly destructive. We have also experienced the worst global inflation surge in a generation. Just a few years ago, the monetary policy debates in the advanced economies was about inflation that was too low, about deflation risk, about tools for providing stimulus when interest rates are as low as they can go. Now, we have significantly higher inflation, and although headline numbers are coming down, underlying inflation is still quite sticky. Interest rates are staying higher for longer. These higher rates are necessary to stabilize inflation. But elevated interest rates also create stress. We have seen some poorer countries, especially in Africa, lose access to global bond markets. And we have seen bank failures. This month marks the 1-year anniversaries of the Silicon Valley Bank failure and in the United States, and the collapse of Credit Suisse, a globally systemically important bank in Switzerland. The example of SVB is especially interesting. They were basically undone by losses on government bond holdings, not exactly risky assets, but assets which necessarily lose value as long-term interest rates rise. There are some rich ironies here. One of the lessons of the 2008 crisis was meant to be that complex derivatives and risky assets were the cause of bank failures. But here, we have a failed bank that got in trouble because of its holding of the world's classic safe asset, and which failed to hedge the risk. In other words, that didn't use derivatives. Well, this is a valuable reminder that risks take many forms, and the conventional wisdom of the last crisis may be misleading for the next one. Overall, it is fair to say that we live in challenging circumstances. Here in South Africa, our region is largely peaceful and likely to remain so, but we are not completely insulated from geopolitical confrontations, irrespective of how far they might be from where we are. Our economy is also not growing, and there are many signs that our living standards are falling. Growth last year was just 0.6%. Since 1994, there has been only 4 years with worse growth, of which one was the 1998 emerging market crisis, one was the 2009 crisis, and one was the 2020 COVID crisis. The gap between South African growth and world growth is now double its longer-term average. We are falling behind. A big reason for this is that other places have functioning rail networks, ports, and electricity, something that we lack. At the same time, government debt has risen too fast and is now too high. Accordingly, we have lost our sovereign investment grade credit rating. This is costing us dearly through higher borrowing costs and lost investment funds. Furthermore, we are on the FATF grey list and have been there for just over a year, since February 2023. We got this high-risk designation partly because of poor conduct by institutions and because of the exploitation of vulnerabilities in the existing financial frameworks relating to anti-money laundering regulations. We feel confident that South Africa will be removed from the grey list by the next review date in 2025, given the fixes we are implementing. But this has been a costly episode for us. The lesson is that joint efforts are required to look after the integrity of South Africa's financial system. We all suffer when this is compromised. At the same time, despite all these bad news, we must appreciate that our financial system is resilient. The test of a system is how well it handles stress. You never want to see stress, but we have had a lot of it in recent years, and the good news is that the system largely coped well. Capital buffers have held up. We have not seen a rise in defaults that could indicate irresponsibly risk lending or large-scale evergreening of loans designed to conceal losses, both problems experienced in various other jurisdictions where financial systems are a source of vulnerability rather than strength. The ability of the market to get through catastrophic events like COVID has been clearly demonstrated. Of course, there are also problem cases, such as certain institutions which we put into curatorship recently. But I think these actions should be interpreted as vigilance, mitigating problems before they grow too large. In a well-regulated financial system, you are more likely to see banks being closed from time to time rather than dysfunction being tolerated indefinitely. Unfortunately, we cannot say the public image of the financial sector is everything it should be. It was remarkable with the allegations last year about banks manipulating the exchange rate of the rand. How ready people were to believe that there was in fact a great conspiracy to rig the rand, and that this had seriously weakened the exchange rate, pushed up inflation, and raised interest rates. Economists and market specialists understood that even if there had been market manipulation by some traders, the macro effects of the exchange rate being a few cents weaker or stronger for an hour or so would have been trivial. The impact on inflation and rates would have been zero. We also saw the Competition Appeal Court rule in January that there was no evidence of a general conspiracy. But this was not the public conversation. Most people could tell that traders were behaving unethically, plotting in chat rooms, and the misconduct was so obviously wrong, it eclipsed other analysis. What I learned from this is that public trust in the financial system is not as deep as it needs to be. I worry about our ability to have well-informed policy conversations in potentially more stressful circumstances if bad analysis can get this kind of public traction. Efforts to bolster consumer education on the intricacies of financial regulation or financial economics are ongoing, but many people have strong opinions on the ethical questions and especially the ethical failures. This is the stuff that can catch fire with the public. If one of these fires start, it's going to be a very difficult conversation and a very difficult environment for making policy. The solution here is the solution with all fire risk. You need to reduce the supply of flammable material. You need early detection systems, and you need firefighting equipment. For our purposes, this means you need to have a financial system which treats people fairly, where misdeeds are detected and are then dealt with promptly and effectively. If you do not have this, the system will be fundamentally unsafe. Ultimately, your moral capital is like your financial capital. You need it most in a crisis. And if you don't have it, that is when you fail. You, the FSCA, are guardians of the financial sector's moral capital. I don't know how you devise a capital adequacy ratio to measure whether we have enough, but let's have no doubt, even if we can't measure it, this trust is every bit as valuable as financial capital. So even though we are at the top of two different peaks, you lead on market conduct and we lead on financial stability. We need each other to proceed. May you have interesting conversations over the next 2 days. Thank you.
I think we can give the governor and the commissioner another round of applause. Thank you very much to both of you. And I know that there may be questions in the room. When we get to the next dialogue, if you've got questions for the commissioner, please can I ask that you note them for that discussion. Commissioner, one of the things you mentioned was how tough things really are in the country for households. It's the same for businesses, it's the same for us as individuals. And so, for those that are a little stretched and are looking for some creative legal ideas on how to stretch the rand a little bit further than it's gone in previous times, I came across a letter from a very resourceful young man. His name is Sipho. He wrote this letter to one of the retailers, the clothing retailers in the country. And the letter reads this way: Dear Sir or Madam, I acknowledge receipt of your letter in which for the third time you requested that I pay you the monies owed to you. Firstly, I want you to know that I by no means dispute my debt, and I intend to pay it very soon. However, I wish to bring to your attention that you are not my only creditor. I have many more, quite as honorable as you, whom I also wish to pay. This is why, at the end of every month, I throw the names of all my creditors into a hat and draw one randomly. That's the one I pay that month. I hope that yours will come out soon. And then, just to make sure that the message lands, he puts this at the bottom. He says, P.S. I regret to inform you that given the threatening tone of your last 3 letters, you will not be taking part in the next 3 draws. You gotta love South Africa. Absolutely. Even when times are tough, we come up with creative solutions. So for those of us that need to get some ideas going, here's one. All right, moving on, ladies and gentlemen, it's now time for us to have a discussion with our Exco at the FSCA. The way that we're going to do that is we're going to have it moderated by Amanda Khoza, who is the Vice President of the Retirement Funds Institute of Africa. My goodness, let me get that right. It's the Institute of Retirement Funds Africa. Institute of Retirement Funds Africa, Amanda Khoza, she will be moderating the session. So since we've heard from the Commissioner, he will be in the room ready to contribute and take questions from you, but what we thought to do was to have the conversation with the Deputy Commissioners so that we do a deeper dive into some of the issues that the Commissioner mentioned. And so, Amanda, if you could please come forward, and your panelists as well. We can give them a round of applause.
I'd like to think of this conversation that we're going to have more like a dialogue of colleagues, less than a panel discussion. It's like being invited to a party and being allowed to ask questions that would typically be seen as having poor social etiquette. So I want to start by asking that question that people generally say you shouldn't ask, and ask my colleagues, what do you do? What are your responsibilities?
What do we not do? Is an easier question.
Kathy,
Oh, gosh, I'm feeling very loud. All right, so I am one of the Deputy Commissioners at the FSCA. I am responsible for regulatory policy, which is, to your question, what doesn't it do? It spans the regulatory frameworks, financial education, our fintech thinking, policy development. So it really is the backbone to a lot of our frontline activities, being in licensing, supervision, enforcement, and the likes. I am also responsible for enforcement, which is the investigations enforcement arm. It's making sure that while we like to have the conversation and an ongoing open conversation with our supervised entities, and we like that conversation to be friendly, sometimes it can't be. And that's when the enforcement arm comes in. Thank you.
But Gerard is very friendly, even though he needs enforcement, I just have to say.
So, Fazana, can you tell us what you do?
So first I just have to say, and the commissioner's left the room, he's very sneaky because he gives you the great opening and then he leaves us to answer all the hard questions. And that in a nutshell is what we do. So we answer the hard questions on behalf of the commissioner. So I'm Fazana. I look after 3 areas in the organization, 2 of which are very front-facing and 1 of which sits quietly at the back. So the first area I look after is our licensing area. So we look at licensing issues across the sector. And this is headed up by Felicity, who you'll meet a bit later today. She'll talk to you around some of the work around cryptos, crypto licensing. The other area I look after is our conduct supervision area, which looks after conduct across the sector, except for retirement funds and except for market integrity, which Astrid will talk to you about. That area is looked after by Kidiboni, who you will also meet later today in our first panel after the session. In this area sits supervision of our banks, payment providers, insurers, micro-institutions, intermediaries, investment providers. Also, for our sins, we look after AML-CFT supervision. So the team is looking at our action items to get off the grey list. And finally, the Office of General Counsel, that's headed up by Fanny Rousseau, who's not on the program today because we keep him in the background because he manages all our litigation when we get into trouble, but he is here today, so hopefully you will get to meet him as well. And that is the scope of the work that I do. Thank you.
And my scope is not nearly as complicated as that. So my name is Astrid, and I'm the 3rd Deputy Commissioner, as you will have gathered. The areas that I'm responsible for are pension funds, as Amanda mentioned. So that's both the conduct side as well as currently the prudential side, which we'll be handing over to the Prudential Authority, and I think the Governor mentioned 2026. So that's the target. It has been a bit of a moving target, but I think we're certainly working towards implementing it by that date. The other area that I'm and maybe let me just mention, we used to have a divisional executive. We still have a role, but it's not currently filled. The divisional executive who was responsible for retirement funds decided that he wanted to move on to new and more exciting areas at a time when pension funds are going through some major reform. So Alano Makubela, who you'll meet, you'll see a lot of tomorrow, has moved over to the other area that I'm responsible for, which we call market integrity and decision sciences. So that combines 2 areas. It's both the capital markets, and when we talk about capital markets, our responsibility, or the responsibility of this division, is about financial market infrastructures. That's the exchanges and the other infrastructure, financial infrastructures that are necessary, credit rating agencies. That's where benchmarks, financial benchmarks will sit. That's where some of the clearing kind of responsibility, infrastructure responsibility sits, as well as the supervision of over-the-counter derivative providers, what we call ODPs. And then the other component to that is something that I have termed decision sciences, and everybody asks, what is that? Well, I think it's terribly exciting. It's really about the analytics. Olana often calls it the think tank of the organization. So that's where we've been building or trying to build our analytics capability, sort of data analytics, as well as where the market surveillance function will sit in future. And then the last area that I'm responsible for, that I'm also very passionate about, is our ICT area that's headed up by Phokeng Mogase, who you'll also meet later today. And that's where the digital transformation that we are going through is directed from, to a large extent. So that's that. Back over to you, Amanda.
Happy to meet you all. What an amazing, set of responsibilities, but it also makes you very vulnerable in terms of the risks that the Commissioner spoke to, as well as the Governor, that happen in the industry, and that you are responsible for in terms of supervisory responsibility, as well as setting policies that ensure the industry remains stable and operates with great ethics and integrity. So I'd like to preface the rest of our conversation with a few reflections on what the Governor as well as the Commissioner spoke to. For me, one of the key takeaways was the vulnerability that individuals find themselves in terms of the cost of living being so high, and the complexity in our industry, which make it very difficult for consumers to engage with the sector with great trust. And, to just harp on the theme of the conference, which speaks to inspiring trust, what did you take out of the conversation and the addresses that we had earlier?
Well, maybe I can start, because you did talk about vulnerability. I think often the TCF principles, for example, we often talk about them. We talk about how we live for our customers, and we are upholding these very valuable principles. But I think too often they may be, well, put another way, they're not there to be applied as inflexible rules, and support flexible industry responses. Mm-hmm. So if we think about the cost of living crisis and we think about vulnerability, we've actually been having this conversation internally around is vulnerability something different from TCF, and why would we need to be expressly considering vulnerable consumers when we've got the TCF principles? But how do we actually give life to the TCF principles? And vulnerability is one, for a financial institution, considering vulnerability, the vulnerability of its customers. It's one way to be really living and giving effect to valuing your customer. I think the other part that came out for me was obviously around trust, but we land up talking about outcomes, and impact. And I think most within the sector are trying to do the right thing, as we are as the regulator trying to do the right thing. But I wonder if more work may need to be done to be embedding a culture, and I think culture is one of these common themes that comes up as well, of thinking beyond the bottom line. And this is not just at Exco level, because it really needs to be believed. Internationally, the conduct world is talking increasingly about financial well-being. We're talking about sustainability. And these are two very real, measurable outcomes, like very measurable outcomes. In fact, even trust, I think the governor had said, we can't measure trust. Actually, we can measure trust, and we are going to deep efforts to be measuring trust across the sector, across industry segments. And it's very important that I think that these outcomes of financial well-being and sustainability are targeted alongside profitability.
And you know, the interesting thing about trust and vulnerability and culture, they're often seen, especially in our sector, as the soft elements of financial services, right? Yet those social constructs and you know, themes are important in order to garner interest in engaging with the sector from procuring our services and our products. And it requires you know, a lot of regulation around consumer protection to ensure that consumers can trust the industry. And without mentioning you know, areas where we have had breaches of ethics and integrity, the Commissioner indicated that that is an area that is of concern and possibly keeps him up at night often. What are your reflections, Fazana, on you know, how regulators are starting to embed elements of these social constructed themes on trust, on empathy, on consumer protection in order to increase financial inclusion while you are protecting our consumers?
Yeah, thanks, Amanda. So I think I'd like to answer that in the context of more broadly how regulators are starting to see themselves. I think both the Commissioner and the Governor mentioned, so the Governor was very polite and he said, we're living in challenging circumstances, but I think we're living in a constant state of crisis. I mean, he mentioned that there was significant regulatory reform after the 2008 financial crisis, and generally that's when regulators respond. But where we are now is, it is always about crisis. I think it's always about being firefighting. And within that context, I think increasingly regulators are redefining what the role is that they play. I have to also just give props to, to the Governor, because it's not very often that you have a central bank governor actually standing up and talking about how important conduct is. And I think that bodes very well for our sector. I mean, generally in the past, there's been this very regressive notion that macro-prudential issues are irreconcilable with issues around consumer protection, fair customer outcomes. And I think what he laid out very clearly is how interconnected they are, and actually the resilience of the sector, the stability of the sector, the economy is dependent on trust. And where does that trust come from? It comes from consumers. So on that point, what we're seeing, because the global drivers of regulation are changing, regulators themselves, as well as us, are reevaluating our role, and I think that shapes a lot of our intervention. So traditionally, regulation, it's been about managing risk. But I think we see a broader role for ourselves. I think it's now about, yes, managing risk, but also, as the Commissioner said, balance that with promoting responsible innovation. We can't get away from that. But I think more and more we're seeing the role that we play around societal resilience and societal protection. And I think that's where we need to understand all of these drivers. We're still kind of unpacking the headwinds from the pandemic, you know. We're dealing with natural catastrophes, issues of climate risk. I think it's the existential crisis of the day. The cost of living crisis that's been mentioned many times. It's actually also redefining what we mean by vulnerability, and I think that's quite important. Tembisa made such a good comment around vulnerability is not just about individuals. It's about individuals, it's about households, it's about businesses. And I think as South Africans, in addition to that, we're dealing with issues around the electricity crisis, we're dealing with issues around grey listing, and we have to be in a position to actually respond to this in an agile manner. And again, historically, regulatory responses have been very rules-based. But if you look at where we're coming from, 5 or 6 years ago, we started moving into this outcomes-based world, and it wasn't very clear how we were going to get there and whether it was going to work. We're now 5 or 6 years later, the world looks very different. And actually, the shift to an outcomes-focused approach of doing things, I think, is a lot more relevant to the world that we're living in. I think to pick up on what Kathy is saying, this approach that we're taking around being more outcomes-based, it requires collaboration, it requires collective action, it requires dialogue with the industry around what are those outcomes we're seeking to achieve. And I think to answer your question, and I think the Commissioner ended off with this, it does come down to how we're seeing the sector at a leadership level actually taking ownership of this, and are we setting the expectations clearly enough? I don't know if I've answered your question, but I think it was quite important to just share with you, before we go into the details, that we're also looking at what our own role is, and that's actually what's guiding a lot of the issues that you'll see both in this conversation and throughout the conference.
No, I think you absolutely did answer the question. I think one of the points that you made that I want to just latch onto is about being relevant, right? And having policies and regulation that speaks to the issues that people are facing, households are facing. And when we speak about the two-part system, for instance, which obviously is a key area, key topic that I relate to as being part of the Institute of Retirement Funds Africa. My colleagues just recently released a news article that raises some concerns around the delays, potential delays that could come up if the two-part system is not promulgated by April, so that industry starts catching up. Astrid, what can you tell us in terms of the progress that's being made, and how responsive is this two-part system to the vulnerabilities the public is facing? There are a lot of people that are agitating for the implementation, and they're quite expectant for that first withdrawal that they can take on the 1st of September. How ready is the FSCA?
I don't know that that's the question we should be asking, actually, Amanda. How ready is the FSCA? Because we think, we've put in place all the requirements from our side. The things that we need to do are fundamentally approve rules. I think we need to do a little bit more than that, of course. We need to also ensure that the industry educates members. And we work with the industry very closely to make sure that they are able to implement. So, in fact, it goes beyond the industry. We think that unions will play a very big role in advising members, and so our team has in fact been reaching out to unions to educate, and in fact we think we need to go quite far down. We need to go to a shop steward kind of level through the unions, of course. And I think, there are complexities. Obviously, it's not just about private pension funds, it's about public pension funds, which is not in our scope of responsibility at this stage until COFI comes into effect. And that we think may have an impact and is something that the National Treasury is considering. There's a lot of speculation about whether the legislative changes will go through in time. Our sense is that they probably will, that by the end of April we will have both pieces of legislation in place, and that will give everybody time. The other unknown in this has been the readiness of SARS, and we are engaging with SARS. The assurances that everybody's had is that SARS will certainly be ready by the time, by September, by the time it comes in. So, but I want to just expand on this a little bit, and this goes to a point that the Commissioner raised in his speech around structural change. I think that is, we're seeing structural change happening through pension funds. We've been living through structural change in the financial markets area for the past 8 years, and it's been interesting to see the role that the regulator needs to play in working with industry to ensure that these changes deliver the kind of results for financial customers that we need to see. So I think the same will happen in the pensions area. where we, in addition to the role that we have to play in approving rules, we're going to have to work very closely with the industry, and there will be different parts of the organization that will play a role. So, for example, Kathy is responsible for financial education. There will be a role for us in that. There's obviously a role for industry. I think and I've forgotten now the other point that Kathy is responsible for that I want to mention. It's the monitoring the impact that this has, actually, whether we are achieving the objectives that have been set with the policy change. So, we're implementing the policy change, and sometimes it's not so easy to ensure that the implementation is smooth and that you achieve those objectives. I think, we've seen it in the markets area where the policy objective was to introduce competition, and where we see that when your regulatory framework provides, for example, for one exchange and for one clearing agent, a settlement agency, when you start introducing change, you start introducing competition, you're opening it up for innovation, but you are also then introducing risk. And I know Fazana talked about risk, and that's not, that there's a move away from focusing only on it. I think there's still a huge role for us to focus on it, and I think it's important that we have the toolkit for that. So, that brings me to my last point, which is data. For us to be proactive, data is a key thing. I think it is in industry. All of you in the room, I'm sure, data quality, those will be a key thing. For us, from a regulatory perspective, for us to be able to really be proactive and anticipate problems, it is going to be about monitoring what's happening, and that is data intensive. So.
Yeah, as part of your responsibilities as well, Astrid, beyond the retirement reform, you're responsible for markets as well. How do you, as the FSCA, approach and enable responsible innovation and new market entrants? How do you support that process?
Well, I'm not sure that I'm the only one that should be answering that question. In fact, I can point a finger this way and that way.
We'll back you up, Astrid.
So we'll allow them to weigh in once you've responded.
Well, I think there are different ways in which you allow for it. Obviously, your regulatory framework needs to open up the opportunity. And that's where licensing comes in, the way you support new entrants. And I think how you also need to be proportionate in the way you approach it. So I think you need to support new entrants. At the same time, you need to ensure that there's a level playing field. So it's not a situation where you've got incumbents that they need to be treated differently. And so, and I think it's quite important that you allow for the innovation and the new entry, but at the same time that you still ensure that the integrity of the market is in place. Because once the integrity is undermined or questioned, then that results in this lack of trust, which the governor touched on. So, and we have a lot of debates in the organization around what integrity is, and the governor mentioned that stability is on our website, integrity is on his website, and we think that as the primary markets regulator, market integrity is our responsibility. But it is quite a difficult term to define, because you could define it very clearly in a capital market space, but I think it has much broader ramifications. And integrity for me certainly means that if I give my money to somebody, that it'll be there's safeguards in place, and that there are rules in place which will govern how everybody plays. So integrity is I think a key part of our mandate, and I think Olana will talk about those plans a lot more tomorrow.
It sounds like it's quite a balancing act, right? Managing the integrity while at the same time increasing financial inclusion with new market entrants. Kathy, do you want to say anything and add to what Astrid has said?
Yeah, I can. Actually, as I'm thinking, the conversation is evolving, I am thinking a bit around, always I'm thinking like outcomes. What are the outcomes? What are the outcomes? And I think so often we assume conduct regulator, consumer protection. But actually, and it goes to the point that the governor was making as well, is that good conduct, positive practices have all these positive knock-on effects. It's through good conduct that we will have fair and efficient markets. It's how we can manage our competition challenges and market structure issues. It's, yes, around supporting the financial resilience of households and businesses. And ultimately, yes, even supporting the stability of the system. And I think that's why these questions of conduct and what is good conduct and good conduct practices really have captured, I think, the international imagination and international stage across the board in the international standard setting bodies, because it is so critical. Just going on to around the financial inclusion, you'll hear we are speaking around financial well-being. And that is because that's what we are here for. It's not inclusion for the sake of inclusion. We're not just educating for the sake of educating. We want households to be increasingly more financially resilient. We want them to live good lives. And they will only be able to do that to the extent that we then are including more, have a more inclusive financial sector. From when we talk financial inclusion as the FSCA, and I'd encourage you to, there's a wealth of thought leadership material out there relating to vulnerability. Well, it will be. We're publishing something soon on vulnerability, financial inclusion, transformation. I'm going on too much, and there's my marketing spiel. But on the inclusion side, we really are concerned with quality access. It's not just around access. And interestingly enough, I don't know if any of you know, we are going to be taking over the G20 presidency soon. And one of the topics is, or one of the, which I honestly didn't think was a controversial issue, was whether the notion of financial well-being should be prioritized. I mean, that for us was a no-brainer. But actually, what it seems like, even internationally, there's this, in some quarters, there's still quite a strong leaning towards considering inclusion as just being access. So could be unfettered access. Now, we know unfettered access to credit leads to over-indebtedness. Access to
unfettered access to pension funds leads to a lack of savings.
Someone
except in
you
this
on
case. So I think the pension funds one, and I'm going to just shift this. I think I'll finish this point and then I'll get back to the pension funds. On this, it is really important that we do look at quality. We can't just, it must be responsible lending. It must be ideally our South Africans having access and using their savings products. What we see is bank accounts that get used as a post box. I think we all know this. The risk of increased digitalization combined with these products actually exposes people more to scams and fraud. So without consumer protection, you can be actually putting people that are already at the brink of poverty over the edge. Just on the pension funds, and sorry, I'm shifting this a little bit, one of the interesting findings from our preferences and behavior survey was actually the mistrust in our retirement industry and the savings products, which we found incredibly surprising. And it really does go to firstly, I think we need to do a lot more work on unpacking why, but Astrid may be able to shed some light on that.
Is the mistrust from the poor rate of payouts?
That's the thing. I think what we did was we were looking across the sector, gauging how consumers feel and experience the sector, as opposed to just what products are you using or what products do you have. And credit, and understandably, came out high in the levels of mistrust, but the retirement sector was the other one.
Maybe I can expand on that, but I don't want to take...
No, go ahead, Astrid.
I think it's not so much that people don't trust the payouts necessarily. It's the trust that the product provides sufficiently for long-term savings.
Okay, so
and that there's
a gap
actually
between expectations.
Yes, and there's a preference for other types of savings and investments.
Okay.
I think that came out quite strongly. I mean, it'd be interesting to see whether this is viewed in the same way internationally, because which I haven't done yet, because I think it's where you've got a mandatory requirement versus it being purely voluntary, that people may not think about it in the same way as if it was just a matter of choice. But let me leave it.
So perhaps strategically, Fazana, in your supervisory role, what issues are you picking up? And, maybe to be less cynical in terms of issues.
You're asking the wrong person to be less cynical.
What's working?
I think just before that, just a couple of responses. So, Astrid, interestingly, I think the Netherlands, our fellow Twin Peaks regulator, had this issue around trust in the retirement fund space, and they've been going through the significant reform process, and it would be interesting to see whether actually that's shifted the dynamic. To Kathy, we focused on the negative sentiment. What was interesting for me in that report was the neutral sentiment for banks and insurers, which I'm not actually sure is what we want either. So yes, obviously the negative sentiment is something that you want to address, but I think when you consider some of the issues that have been raised today around the importance of financial well-being, empowerment, I'm not sure we want our sector to be responded to neutrally. I think you kind of want consumers to actually feel extremely confident and optimistic. So it's probably an area that we need to interrogate a lot more. In terms of your direct question to me, so again, I want to respond on this issue of market entrance and capacity building. So my team will tell you, and I'm going to look at it from the perspective of our role in respect of market participants as opposed to the consumers, because I think we can talk a lot about that. But my team will tell you, one of the things I'm extremely, I don't want to use the word passionate because that seems too emotive, but I feel very strongly about is that...
You can just say passionately.
Passionate regulator, I don't know. I feel very strongly that as supervisors, we do have a role around capacity building and implementation support. I think when you're talking about confidence in a sector, a strong sector, it needs to be one that's vibrant, that's dynamic, that's made up of a diversity of institutions, big, small, medium size. And I think what the shift to an outcomes-based world does, because there's this flexibility, there's this openness to have dialogue and collaboration, there's a lot more room for us to engage with especially new, smaller and emerging market entrants on how to navigate the landscape, to make it less daunting for them to go through the licensing process, to go through the supervisory process. I think that's being preemptive. I think it's a role that we have to play. I think we need to create that more enabling environment. Currently, we do it in pockets at the FSCA. So we do it, for example, we've got a team that does it for smaller FSPs in the funeral space. We've got it more recently. Our MLCFT team has been doing a lot of capacity building and training for institutions around managing AML, CFT risks. It's done to a certain extent. Our licensing team does a little bit of support. I think we're particularly seeing we're going to need that as the crypto supervision evolves. But I think generally this is something we need to elevate more strategically. We need to come up with a more coherent approach to what is our role in terms of supporting these new and smaller entrants who may not have the resources, capability, or scale to have kind of their own compliance and risk people. And I think that's part of the collective effort to make sure we've got a sector that's a lot more thriving and dynamic. So this is what I'd like to see.
So I'm going to give an opportunity to the audience to ask questions. I'm not going to be selfish and ask all the questions. I'm sure you would like to know more about the strategic priorities that the Exco is planning on implementing. So I hope there are roving mics for questions. But before, as you get ready to ask your questions, I'm going to ask the Commissioner a question, since he's back in the room. So one of the key elements in your talk spoke to inspiring trust and integrity in the industry. I'd like to ask, what's keeping you up at night, Commissioner?
Thank you very much, Amanda. So I want to come to your question now. I did have one or two comments to make just on some of the conversations that you've already been having. The first one is around something that maybe has not been touched by my colleagues, and I think is quite important in terms of our mandate. It is competitiveness. It is capital markets competitiveness, particularly. And I'm raising this because recently there's been a lot of discussion and debate about our foreign investment framework. And I think that, I'd really like us to have an opportunity in this conference to hear from the sector about, some of the issues that have been topical around how we approach foreign investment. Let me, though, offer a view, which is maybe my view, or it is an FSCA view on this. I think that there's a price to pay for openness. And I think that sometimes we don't appreciate that price. South Africa is a small, open economy. We compete with other small, emerging markets for capital from around the world. But sometimes in how we position ourselves, it is as if everyone is falling over themselves to come and invest in South Africa. Whereas the way to think about it is, what are the things that we need to do to make South Africa as a market and as an economy attractive to those who are allocating capital or making those capital allocation decisions from around the world. We started, when I say we, the whole country, Treasury, of course, being the policymaker, a journey 20, 25 years ago. I don't want to refer to it as it was, because it might sound a bit controversial, but it was called gradual liberalization of exchange controls. And what that meant was that we were moving from a world where we were fiddling with very artificial limits and controls about what investments can be made from South Africa to a truly risk-based framework that aligns us to how capital is allocated and invested around the world. And I think even with the challenges that we have and some of the issues that have been raised. Then you have foreign players coming into our market, eating the breakfast of some of our domestically licensed firms. I do think that we need to start this conversation about what is the best framework to have. And it cannot be one that is backward looking. It cannot be one that still wishes for a time where we were controlling as opposed to risk managing. So I think it's just an important point to make. Another one, and this is also relevant to capital markets, is about market surveillance. And I'm sure Orlando will talk about this tomorrow, or Astrid can also add, and how we see the kind of reform agenda progressing around that. We started from a time where you had a dominant financial market infrastructure. For a very long time, we've been having conversations about, now that you've licensed more than one financial market infrastructure in all of the very different types, actually, including exchanges, clearly one has to rethink the self-regulatory model that we had in place. And that will mean a much more, I think, enhanced role for the FSCA. And yes, it will require capacity building. It will require that we position ourselves quite differently, given the historical context. But I think it's quite important for us to begin to have these conversations about, what is the expectation in that kind of different world. The decisions have already been made, the policy decision, to open our markets. And I think it's important to underscore this. That decision has already been made. What we are busy with now and what we must be engaging with is, so how do we operate in the context of much more open markets? And I don't think that the solution, well, we certainly don't think that the solution is to try to buy back some of that openness. And I do think that it's just important to position this as a regulator. There are risks, of course, and those have to be managed, and those have to be approached responsibly. But I think it's quite important to realize that we have to operate within the context of what we've now created, rather than to think that the solution to whatever challenge is to buy back the openness that we have already achieved, which is an achievement for this economy. Back to your original question.
So none of us ever answer your questions directly.
Which is fine. It's supposed to be a conversation, so that's fine.
All right. So back to your original question about what keeps me awake at night. I mean, I think that the sector has actually progressed quite significantly in embracing conduct, in embracing good conduct. I think that in many of the conversations that I've had with many institutions over the period that I've been in the FSCA, one appreciates that at a very senior level in the organization, in many organizations, CEOs, chairs of boards actually champion the cause of good conduct and appreciate that as a business imperative and not a compliance issue. Of course, there are elements which are compliance, but appreciate it as a business imperative as opposed to just a compliance issue. I am just sometimes not sure that that appreciation lends itself as it should to customers experiencing the benefit of that appreciation.
I hope I'm being very, very diplomatic, but so I hope people can still understand what I'm trying to say. I think that is one thing for the conversations at the board level, to appreciate that this is very, very important, and communicate that to staff. But of course, the people who should actually be able to say, in how we are interacting with these financial institutions, in how our issues are responded to, in the information that empowers us to interact with these institutions, we can see this positive change. Because what is the role of a regulator? Why do we exist? We exist because of asymmetry of information. These institutions are large and complex, and the design of these products can also be complex. There therefore needs to be someone who's able to bridge the gap. And if that doesn't happen, if the appreciation of treating customers fairly, the implementation of the principles of TCF, the information that must be provided to people to know what recourse mechanisms they have, and so on, if that does not trickle down in the way that builds trust and confidence at the level of financial customers, we still have a bit of a longish way to go. So that's, I think there's good progress that's being made, but we have got to stay the course until this is a more commonly shared experience by financial customers, that they are treated fairly by financial institutions.
It reminds me of a time when the TCF was launched, and I recall at the time our CEO indicated that this is not a regulation. This should be the way we do business, and it aligns directly with the values of operating with integrity, and therefore it should not be seen as a compliance factor, but it should be embedded in the way we run our businesses. And I think one of the other items that I took out from what you just spoke about is that our regulatory framework should be quite robust and be responsive to be able to allow for greater competitiveness for our sector. Are there any questions from the audience? And there's a gentleman there.
And there.
And there's a lady there as well.
I've got the mic, should I carry on?
If you've got a mic already, you can start asking your question.
Yeah, I'm sitting at the back. It's a bit dark here. So good morning, everyone, and honestly, much love and respect to the work that's being done.
Sorry, I can't hear. I don't know. We can't hear the question.
Do you have a mic?
I do have a mic. Is
Oh,
it
okay,
coming
there we go.
across?
Perfect.
Okay. Good morning, everyone. And as I was saying, a lot of love and respect for the work that's being done by the Conduct Authority. My name's Kumar, and I'm from the Banking Association. I'm not representing the views of the association, so all protocols observed. But I do. But I do want to bring in something from a non-conduct specialist that is observed. So the governor spoke about not being focused totally on the technocratic arguments as a solution to the problems that are being faced. Farazano, you were a bit bold and you took that into saying, well, I'm not going to say it's just challenging times, but it's also crisis times. But here's the trend, and it's probably not a correlated trend, but an observable trend, is that as technology, and I'll go further to say market improvements, improvements to regulations, improvements to policies, improvements to all sorts of things are happening, they're not evenly distributed. So the crisis we talk about is not a crisis of the people in this room, but it's a crisis of people that live in another space and in another time continuum entirely. My friend Fani from SASA, and I work in payments and cash, highlighted to me, said there's a commonality that he looked at across the world, is that cash becomes really important in times of war, in times of crisis. And we had this wonderful argument, or wonderful conversation, not an argument, talking about, well, does that mean that the people that are living in the dispossessed and in the inaccessible environments are living in a constant form of crisis? Right. So the reason I'm bringing this in is to tie in the element of inequality, the danger of going on a trend line that says improvement and modernization, because people like me, I've gone well beyond trust. I have power over my financial providers because I have lawyers, I have private bankers, I have all sorts of things. My question is, where does the line come in? Because there's only a couple of ways algorithmically that you can solve when the race is unfair to the various participants. You either stop the allocation of innovation and benefits to those that have it already, you reallocate the benefits and the like, or you look at a tertiary form of stimulation that gives those behind a way of getting forward. So I'm interested where inequality specifically comes into this equation and how it's brought into this bigger picture thinking in terms of trust and crisis. Thank you.
Thank you for that question. Can I ask somebody else to ask a question? And if you can just make it succinct, I don't want to be in trouble with Tembisa in exceeding the time allocated. So can we get the next question quickly?
Good morning. My name is Dion. I won't mention my employer lest I get into trouble. But thank you for the opportunity to ask my question. So one of the points that was raised in the discussion was around the distrust towards retirement fund products and savings. In my view, that is also linked to a lack of financial literacy in South Africa. We have some of the worst levels of financial literacy. And my question to the panel would be, has there been any insight or discussion around bringing different role players within a customer's financial journey to bring that financial education? Not just from your product providers, but from other role players like your benefit consultants, your financial advisors, even employers, so that at the very least, customers can have a basic understanding of these financial products. Because often as a product provider, you are dealing with complaints because a customer didn't understand how the product works. So our initiatives over and above what FSCA is doing to leverage those relationships.
Okay. Anyone want to tackle those questions?
Do you want to start? I'll come in after you.
I'm happy to start. I know you'll provide all the missing detail and context, Kathy. So the reason why I wanted to come in is because this is, your starting point was retirement funds. And I think it's maybe illustrative of other things we're thinking about in the organization. But I'd like to approach it from that perspective. So retirement funds, absolutely. I think, you know, we've spent a lot of time focusing on the sustainability of the funds, and obviously that's critical. But what we see as equally important is ensuring that, for example, the kind of information that members, pension fund members receive is clearly understandable and is communicated appropriately. So what we need to do from our, or what we're thinking through doing from our side is, clearly there's a discussion around what role we as the FSCA play in financial education, and that Kathy will definitely talk to. But I think from a supervisory perspective, we also have a role in observing, monitoring what kind of communication is going out and engaging with the sector where we think it may not be appropriate. So that is more of a thematic review that we think, and is clearly a role that we think we need to play from a supervisory perspective. Kathy?
So interestingly enough, I think the two questions are related. Because when we're talking around inequality and almost access to products, or in access to certain products, and the way that the market is evolving, favoring some over others, the flip side to all of this, and we have spoken mostly around the financial institutions, and we often will be talking around product design and delivery and whatnot, and those are all really important things. But the other crucial pillar to this, obviously, is the empowerment of consumers. And that it's really only when consumers, firstly, have the knowledge and skills and awareness of managing their own money and understanding what the role of the financial sector is and what products are available and how they can be best used, but more than that, actively using their voice to say, this is not what I want, this is what I want, and exercising choice. That's when I think we will start seeing an increased synergies towards what the sector is offering versus what consumers are wanting and needing. And I think so often it's easier to say we've got high unemployment, high levels of poverty, but we see that people are engaging in the economic sector. They are transacting. They're just transacting in cash. They are saving. They're saving through stockpiles. And so we have to ask why. And part of that then, and yes, very much an important role for the FSCA to be driving that conversation, just to alert you that as part of this and recognizing the scale and the magnitude and the importance of this challenge, we are going to be partnering with actually others in the sector to be not only for Money Smart Week, but a summit on exactly these kinds of issues, which you'll be hearing about in due course and will take place later in the year. I think also from a FSCA's perspective on financial education, we are increasingly mindful of the fact we cannot go out and do it all. You who are here from the sector have this front line, should have this frontline connection with your customers. So you are really probably the best placed in many instances to be helping consumers become more informed, more empowered. And we want to partner with you to be able to do that. We have, sorry, just one more thing. We have actually started down this journey of partnering specifically with financial institutions. So please, in order to start rolling out financial education to your customers. So if anybody is interested in this, please do get in touch with us as well. Thanks.
Okay. I've been given an allowance to ask 2 more questions.
Thank you very much. My name is Busiso. I'm here at the back. The first question I'm having is on the mutual evaluation report that led to South Africa being to be grey listed.
Please, can you start your question again?
Okay. Can you hear me now?
Yes, we can.
Oh, thank you very much. My first question is on... I would like to thank you actually first for organizing this event. It's been a long time coming, and then thank you for engaging with us, and then we really appreciate this. But the first question I'm having is on the mutual evaluation report. The draft or the response that we received from FATF is that most of the shortcomings that we face as a country when it comes to not complying with what was required by FATF was on designated professionals and businesses that were not financial businesses. And then at the end of the day, the direction that we are seeing lately from the regulator is that they are coming more to financial institutions. And then we're having a lot of on-sites and everything that are looking at correcting the wrongs that were identified during the mutual evaluation. So I'm wondering, actually the question that I want to pose, or the suggestion that I want to pose, can't the regulator assist the other regulators or industry associates to deal with the DNFBPs instead of focusing mostly on the industry that is aware and then is making sure that we comply with what's required by FATF? My second question is on FATF, on coffee actually. How far are we? And then what is happening lately? Thank you.
Okay. Thank you.
Yeah, so I'll let, Kathy will take the easier question on coffee. Well, I don't know if it's an easier question, but just on FATF, the mutual evaluation, thank you for that question. I think it's a great question and a great point. I'm not going to answer it now. The reason for that is that I hope you're attending tomorrow, because we've got a panel tomorrow discussing this, and to your point, it's not just about how the financial sector is responding. So we've actually got Treasury on that panel who is coordinating the national response. We've got the FIC that's dealing with the DNFPs. Obviously, we will talk through what the financial sector is doing. We've also got someone from the industry that has overview of both the financial and non-financial sector. And I think these are extremely important questions to raise to that panel, but also to see whether some of it is answered in that discussion. So I'm going to keep you in suspense and make sure that you attend tomorrow. Thank you very much.
Okay, did you want to respond to the Kofi question?
So there will be National Treasury officials at this conference.
So basically, come back tomorrow is what we're saying.
What I will say in addition to that is, I think what we are not waiting for Kofi, I think is an important point. And if you've seen, if you've seen our responsiveness through regulating CASPs, just as illustratively, we're moving on to benchmark providers and the likes, the changing way in which we are supervising all of these things, which will be discussed over the course of the next day and a half, those are all already starting to live Kofi. So we have been doing a lot of work in terms of the supporting regulatory and supervisory frameworks, and those we are going to continue to roll out as they are ready. We have established a number of work groups through our market conduct committee that we're actually working with industry to finalize the cross-cutting frameworks, the regulatory frameworks, which can be implemented even ahead of Kofi, talking to issues like governance and other good business conduct practices. So it's a journey, not a destination.
Maybe to add, even in our, we've just procured a back-end IT system, quite a major one, that we'll be rolling out over or implementing over the next 3 years. And we have to anticipate the impact of Kofi in the way we design things. So as an organization, we're moving towards Kofi implementation, even in the absence of a firm deadline on it.
Okay, I can take one more question. Do you have a mic?
Yeah. Good morning. My name is Wayne Hiller van Rensburg. I'm the Executive Officer of the Institute of Retirement Funds Africa. Although I come from the retirement sector, my question is more a principle and a broader-based one. It's actually around budget allocation. I've had a look at the financial statements, and when you look at the levy or revenue from various sectors, a question I have is, how is that revenue related to the services offered to the various financial institutions regulated in that sector? So obviously I have a bias to a certain sector, but it's a more principal question.
So our commissioner at the Accounting Authority has conveniently left the room. I think he should answer the question.
But Kathy
will answer. we are laterally delegating to Kathy.
All right, so the levies discussion and the budgeting is a big one. That in itself could probably take a day. And even that is in a state of being revisited. So keeping in mind that the FSCA was not, we didn't just wake up one day on 1 April 2018. There was already an existing financial services board which had an existing levy raising model. We have largely incorporated, we've incorporated that. In incorporating it though, we did go through an exercise of looking to see from a resource allocation perspective how we needed to be resourcing the organization and allocating resources across the organization, understanding that we went from a switch of being an institutional base to now these, licensing, much more functionally driven. I don't think we are quite there yet. Kofi will really help us in that all that categorization, because what we are still sitting with is levies linked to a financial institution type, as opposed to recognize, which is correct, but I think the step further will be to recognize where you are doing, whether you're doing less activities or more activities, and depending on your size and depending on your risk that you're bringing to the system. So your levy contribution should be more commensurate to that. We will get there.
Amanda, can I add just something quickly? And it's not on the framework, but just to share with you a little bit of what else we're doing internally to help inform those discussions. So, as you would know, when we were set up 5 or 6 years ago, we had a very specific idea of what the design of the organization should be, allocation of resources. 5 or 6 years down the line, obviously it's given us an opportunity to reflect, and we are in a process of actually assessing the way the organization is set up, how we allocate resources, whether the structures are actually aligned to the mandate, etc. And hopefully that will help future conversations in terms of making sure allocations are done in line with actually us optimizing our resources, because you also want to make sure it's not wasting of funds because maybe the organization is not set up optimally, and I think we've now got enough information to do that assessment. So this is outside the levies discussion. I won't comment on the framework, but that's kind of work that we're doing internally. Thanks.
Okay, this isn't misconduct. I have been permitted to ask one more question.
Thanks.
Tambisa, you're
Can
being
you
too
hear me
generous.
okay? So first of all, just one comment. It's really great to see a panel of senior females in the financial services. So go women power. And also just 1 or 2 points I want to make before I get to my question. The one is, I think going on the digitization path is great because it is so important in terms of keeping up. So I'm really excited to hear about that. And the decision sciences unit, I mean, you guys have the most data in our industry. So going on that route, I think also is going to have huge amounts of impact in the long term. So I think I just wanted to focus on 2 elements, and the 2 elements are around communication. The one is there's been a couple of comments made around how it's the responsibility in retirement funds to communicate to their members. It is an easier job said than done. And I think especially when we're moving in the retirement fund space into 2 parts, there's been a lot of discussion about will we be ready by September, or everybody will be ready by September to make sure we can pay. But from a member expectation element, members want us to be paying on the 1st of September, even though it's a Sunday, just putting it out there. So to say that SARS will be ready by 1 September, and the administrators need to have ready to go way before 1 September to be in a position to pay the sheer volume and money of claims that are coming out. And I'm worried that that's not being taken into account. There's almost like a tick box of, yes, the regulations will be through, don't worry, your rules, you know, et cetera, et cetera. But how do we work closer? Because this is the biggest change to hit 6 million South Africans on the 1st of September. And I'm worried we're taking it on a bit of a tick box approach. And as administrators, it's transformational. There is not a piece of paper, there is not a process, there is not a system that is not needing to be changed by then. And everyone's working on that D-Day as long as, but a lot of those things need to be ready way before. I mean, we talk about rules, for example, but to say your rules will be approved by September, we're building systems based on rules that haven't even been approved yet. What happens if they're not? Do we have to go back and change? So I think it's not enough of a partnership in getting to where we are. It is a very challenging time, and we know that deadline is there. So I'm sort of appealing to say, how do we work as a communication? You know, we say rules will be approved, but there's a lot more than rules as well that we need stamped. There's guidance notes, there's regulations, there's all of these things that need to start coming out now if we're going to be ready. The other thing is we need to be communicating.
So now I am stepping into misconduct territory, unfortunately.
Okay.
So the panelists are going to be available for the rest of the conference, which will give you an opportunity to ask questions later.
I think you'd make an excellent regulator, Amanda. Just briefly on that, I and the team and as an organization, we couldn't agree with you more. This is a change that we have to manage together. We have issued a communique to try and guide industry already. We've invited the industry to submit rule changes to us already now. so that you can get the feedback up front. Our commitment is that we know that officially you'll only be able to submit your rule changes on the 1st of September, and we've given ourselves 3 months. What we do need to manage collectively is the understanding, the public understanding, that nobody's going to be able to pay out on the 1st of September. So, agree with you entirely.
Which also goes to the education and awareness again.
It does. That is a broader role, yes. It is not purely member education, it's actually a broader communication that needs to go out to the industry. But absolutely, we need to, as an industry, the industry and the regulator, we need to work very closely together to ensure, and it's not just us, SARS, as you indicated, needs to be part of the discussion. But we do need to be very pragmatic, very clear about how we're going to rule this out. We do need to anticipate that things will go wrong, and we need to manage expectations on the outside. That's why the union piece is important, but that's also totally in agreement why we need to communicate at a much broader level with the public. And Tembisa is a key part in our organization in that regard.
Okay. I think that brings us to the end of our conversation. Thank you very much for the questions and also for being vulnerable in allowing us to have the conversation and ask the questions that typically we would not have the opportunity to ask. And for being responsive, for being engaged, and being transparent about the strategic priorities of the organization. Thank you very much. If you could please give them a round of applause.
Thank you very much, Amanda. Thank you, Deputy Commissioners. I know we have gone over time a little bit, but I do think this was such a critical conversation because, as you'll see over the next 2 days, what was discussed here and some of the sub-themes that have emerged will be framing the conversations as we go along in our discussions. And just to give you another sense or a recap of what's to come, after our short break now, we're going to go into a conversation around culture, governance, and accountability. And that's really the essence of what conduct regulation is about. And thereafter, we're going to talk about some of these technological developments, AI, consumer protection, and then also touch on crypto assets and where we are from a regulatory point of view with that. So lots coming up. Sustainable finance is also another theme we'll discuss today. If we do go over a little bit on our program towards the end of the day, please note there is a mocktail event, mocktails, later on, so we will apologize profusely at that point. For now, we're going to take a short break. It's now 11:15. Could I ask that we be back in the room by 11:30 so we can continue? And also, by the way, if the air conditioning in the room is a little bit too cold for you, unless, of course, you, like me, are part of the private summer brigade, please let me know so we can just make adjustments to that. Thank you so much. Now, he assures me that what he has done is he's switched off the air conditioning altogether for a little while until the very cold air blows over, and then he will put it on again. If that does not happen, the person to stone is not this one. It's this one. We're about to start. Just a quick reminder for those of us that are posting anything on LinkedIn, on Twitter, X, and on YouTube or any other platform. We do have hashtags. Our hashtags are FSCA Talks and FSCA Con 24. FSCA Talks and FSCA Con 24. If you've got questions that were not answered in the previous session, or if you get questions from this one and you really run out of time, please also pop those questions or comments through to events@fsca.co.za. So, just to give you a sense of how we are going to be running our panel discussions, we've got three that we're going to cover today, plus a presentation. So the first one that we're going to get into is one on culture, governance, and accountability. Thereafter, we're going to AI and consumer protection, and then we talk sustainable finance. The format that we're going to take is we are going to have a short presentation that kind of frames the discussion and then go straight into the panel discussion. For this first one, I would like to invite to the stage Lizanne Porter, who is from the FSCA, to just give us that short presentation, and then Cindy and her team will take it forward. Let's give them a round of applause.
I'll just get some more water here. Okay, so thank you, Tembisa. It's an absolute privilege to be here today. I must say, I heard that there were going to be bankers in the room, so I wore a suit and tie, make myself a little bit more relatable. But it's really wonderful to be here today, and I think the topic that we have, that the panel has, and that I have to discuss today, in culture, governance, and accountability, ties in very nicely to what has been said this morning, and in particular, that these are actually building blocks of trust. So for today, the agenda, just a couple of points I'd like to make. First, I just want to talk about the evolution of market conduct, and I know the Commissioner spoke about it this morning a little bit. Why there is this focus on culture in particular, what are cultural drivers, that we identify the link between culture, governance, and accountability, and then just the collaboration that's going on. What are we doing from the regulator's side? So the evolution of market conduct. In the past, we had a functional model of regulation. The Governor also mentioned it this morning. It was very much silo-focused. It was reactive. There was a lot of box ticking. It was ritualistic, mostly adversarial. So only the regulator and the industry only got together when there were problems. It was non-strategic, it was a little bit backward-looking, and it was very rules-based. Where we are now is we are being preemptive, proactive, forward-looking. There is a lot more intensive and intrusive. We do have a lot of collaboration between the regulators, but also with the industry associations. Risk-based is a very big focus for us, so we are putting our time and our efforts and our resources into risks. Outcome-focused, Fajana mentioned it, and you're certainly going to hear it a couple of times today. It's really where we are moving towards. We have a comprehensive approach. We focus on business models. We focus on operational requirements. We align to international best standards. And there's really been a very strong evolution over the past couple of years, and the supervisors in the room will tell you that as well, where we've moved away from talking about the TCF outcomes and the 6 TCF outcomes, and we're really moving to the proactive management of conduct risk. So why is this happening? Why was there this evolution? You know, those of you that subscribe to Darwinism knows there's always a trigger for evolution. So what caused this evolution? Conduct and culture is of increasing importance, both from a prudential and a conduct perspective. Because of the rapidly changing financial markets, you heard the Deputy Commissioners talking about it, the drive through innovation, the shifts in consumer expectation, the fact that people are more educated and there's more information out there, whether it's accurate or not is another question, and then broader societal changes. So that really drove this shift. But why is there a focus on culture in particular? An effective culture is pivotal to strengthening and maintaining public trust, which is why we're here, and confidence in the financial sector. I think it's vital to understand the key components of what is corporate culture. These can significantly influence the achievement of a lot of outcomes from between the financial institutions to financial customers and also to other stakeholders. But if you really then go into what is culture, what are we talking about here? You can describe culture as and I've got the definition up there that I think it's from the IIS's paper, but you can describe culture as the collective principles and philosophies and goals and standards, and there's basic assumptions in an organization that drives decision-making, that drives the actions, and it then ultimately impacts the behavior of the organization. So I've often heard them compare culture to an iceberg model. You've got the area at the top, the visible area, where you can see the behavior. It's the easy part to spot. And then you've got the mindset of the organization, that's underneath the surface, which is a lot more difficult to capture. I think what's important to note is that each and every organization's culture is unique. There's no right or good culture. There is your culture sustainable? Is your culture healthy? Is your culture purposeful? Is it safe? Are you effectively or ineffectively driving outcomes as a financial institution? So the expectation from financial institutions is that they must embed culture in a manner that consistently promotes sound prudential and conduct outcomes. And the job of the regulators is that they must assess the effectiveness of the financial institution's culture when they are actually delivering on these outcomes. So you need to ask yourself, does your culture, the culture of your financial institution, effectively promote positive outcomes that relates to the overall safety and soundness of the organization? And is it in the interest of financial customers and other stakeholders? And is there fair treatment of customers? Managing culture is not a once-off event. You can't launch a culture project and it runs till December and then you're sorted. There needs to be constant reinforcement to really get permanent and meaningful results. It is really an evolution towards being culture-focused. There are 3 quotes up on the screen that I found very interesting. It's all from international organizations. The first one up there is from the PRA. And what I found very interesting is that basically it says that misconduct, it's really reflected in its core through deficiencies in culture. But it comes out in the wash, in governance, in remuneration, in risk management. So the core of the problem might lie there. And the problem very often starts with an unhealthy tone at the top. The G30 quote, on the other hand, is also interesting because this basically comes down to not all scandals in the financial sector are necessarily because there's a bad overall culture in an organization. The problem is often that the elements of the culture is misaligned with the outcomes that they're trying to achieve. And that then drives inappropriate behavior. And I think then you sit with challenges of delivery on outcomes. The last quote there from the FSCA in the UK is also nice, and I think it segues to the next point I want to make, which really relates to what the key drivers of culture is. And that relates to leadership, to purpose, to governance, and appropriate remuneration systems. So what are drivers of culture? What causes it? What is the unspoken culture of an organization when you look at them holistically? I've grouped what I would think the three categories of drivers are into three categories here. Firstly, vitally, leadership, and the commissioner spoke about it, the governor spoke about it, the deputy commissioner spoke about it. The importance of leadership, the tone at the top. What drives an organization? What are your values? What are your objectives? What are you trying to reach? What are you working towards? Is there leadership accountability? Is there legitimacy in your organization? Is there, so these are the types of questions that you have to look at, and that starts with the board. Risk awareness and integration. What is the levels of regulatory knowledge and understanding and clarity in your organization? What are the skills that you have? Are you aware of the fundamental impact that your organization can have? That it has. There's been a lot of talk about the impact in retirement funds. Do you understand the impact that your organization has? What does your internal communication look like? Do people understand? Is there one voice? Do people understand what the message is that's being carried? Do you consider diversity, equity, and inclusion in your organization, both from an internal perspective, but also when it comes to your customers? So incentives and penalties, and also the governor mentioned the importance of managing misconduct, effective consequence management in an organization, and appropriate remuneration performance. We're all human, we're all driven by remuneration. So what kind of behavior does your remuneration practices drive? The arrows that show in different directions, I think, kind of shows the two sides of the coin that you can get. If you have an effective culture or a sound culture, that can help excessive risk-taking, which can then lead to more prudent and fair outcomes for customers. If you have an ineffective or unsound culture, that can serve as a stimulant for risky behavior, and that leads to adverse outcomes for financial institutions, for the customers, but also actually broader for the sector as a whole. And these two examples are I thought, very interesting. So if you can see how culture links with prudential and conduct elements. So if a financial institution is led by an ethical board that demonstrates transparent decision-making, that reflects the culture. But that can help reinforce the implementation of strong governance and proper risk management, internal control systems, and that then relates to the prudential element of it, and it lowers instances of unfair outcomes, which is then your conduct element again. So you see how it interlinks with one another. If a board, on the other hand, is driven solely by the interest of short-term profits for stakeholders, that's going to potentially lead to setting aggressive profitability targets, which is now the prudential side of it, and that can incentivize unfair product design, unfair sales practices, inappropriate claims handling. That could lead to large-scale consumer complaints, reputational damage, and actually that could also lead to prudential challenges in an organization. So you see how it's really interlinked. So on the link now, and the accountability, this is where the accountability comes in. It starts at the top. I like the way they often refer to, so you've got the tone from the top, the mood in the middle, and the buzz from below, or they also often sometimes do the echo from below. I prefer echo because it echoes what's coming down from the top. The board is responsible for the promoting and the overseeing of the effective governance and culture from an organization. The accountability starts there. Ultimately, the board is responsible for implementing the desired culture throughout the organization in each and every level. The board is responsible to ensure that there is appropriate risk consideration in the sense that there's an integrated and holistic prioritization of high risks to empower decision-making. But how do you empower decision-making? You must have the right data. You have the data, have the right management information, and that will inform actually the measuring delivery of the right outcomes.
I spoke about diversity and inclusion, but diversity and inclusion at the representational level at the board, when it comes to knowledge and skills of the people you have in the organization. Also setting the strategies and objectives, those are the more common responsibilities on a governance level, oversight over senior management, and then to promote a culture of openness and debate in the board, but throughout the organization. People must experience psychological safety in an organization to have the confidence to speak up when something goes wrong, because that's when misconduct is best managed. Mood in the middle, the responsibility of senior management is to pull those strings, make sure that compliance happens, fair treatment of customer outcomes are achieved, implementation of the governance arrangements that the board have set there, and then the decision making, the echo from below. That's where you're going to really measure it. It's a lot like, if you want to look at the country, you look at the people in the country, not the leadership. If you want to look at an organization, measure middle management, senior, lower levels, and the tone there, because that's where you're truly going to see what you're measuring in a culture of an organization. A positive tone from the top can really help to promote a culture of openness in an organization, and that will then set the norms for ethical behavior and for the middle management and down to the front line. So this is a nice schematic review, just showing how it all fits together. You've got your drivers right at the top, and they influence culture. It's all the things I've been speaking about. From there, you've then got the culture that impacts the actions and the behavior and the decisions. But it's a two-sided sword, because the actions and behavior also impacts the culture. Those actions and behaviors lead to the prudential and the conduct outcomes, and that ties to consumer protection, financial stability, managing misconduct, and public trust. So what are we doing, lastly? Just from a collaborative perspective, and I know the panel is also going to be talking about that, from a supervisory perspective, I think fundamentally the way that supervision work has changed. We now expect financial institutions to be able to demonstrate solid leadership, cultural commitment in embedding principles that relate to both prudential management and fair treatment of customers. The goal is that you must be able to demonstrate that you, as an organization, are effectively achieving your outcomes, rather than us prescribing how. Is also a requirement to promote the outcome-driven culture, which is very important. And you must ask yourself, does the failure to deliver on an outcome link to a cultural or operational or a procedural matter? Also important to note that although there's been this entire shift in the way that we supervise, and also in the regulatory framework, which I'm going to touch on now, there will still be rules that are introduced. If there's an instance where there's significant inconsistencies between the expectation on one side or that there's absolutely no other way to do it, we can still introduce rules. But we have moved on from doing that. So we now plan to work with the industry to move towards the outcomes. And if at that point where rules are necessary, that's when that will be considered. And that goes to what we're doing on the regulatory side. I know there has been talk on COFI in the previous panel, and they've discussed that, so I'm not going to go to that. Just to say that these are the two things that we're predominantly from the FSCA side working towards from a frameworks perspective to implement all these requirements that I've been talking about. COFI really forms the basis of placing the requirements there on the principles, right business principles, culture and governance requirements, accountability of the board, the oversight over governance requirements, when it comes to the roles and the responsibilities and duties, that will be sitting in COFI. But we also have a very exciting project that we're working with the Prudential Authority, which is a joint standard on governance for financial institutions. That is a cross-cutting standard. It's very much principle-based, and it is focused on good governance outcomes. It aligns to the King Code, which I think is also very important, which is everyone's very comfortable. And then we touch on a couple of themes: culture, leadership, ethics. We look at some framework requirements, conflict of interest management, importantly, principles relating to AI and the use of AI and the governance of that, remuneration and incentives. So these are all the kind of regulatory projects that we're working on. And I would really like to implore you all to participate when you get these instruments, comment on it, engage. It does make for a more stable and a more appropriate framework. So please do look out when we consult on these. But I think that is where I'm going to end for now. I'm going to hand back over to Cindy and the panel of experts, which I'm very sure is going to give us a very thought-provoking and very interesting concepts on governance. So thank you.
Wow, thank you, Lizanne, for such an insightful presentation. I must say I had my own aha moments as you were talking. And I think it became quite clear for me that the importance of culture cannot be overstated, and that there's a big role for each and every leader in this room to really go back and instill the cultural accountability in your spheres of influence, but also making sure that you're creating the right cultural balance at the end of the day to ensure that you continue to inspire trust. But what was of comfort for me as well was that managing culture is not a once-off event. I could see quite a lot of people doing a bit of introspection in terms of where are we with our culture assessment. But I can tell you, from what you've just said, you can go back and start again. I mean, it's something that requires ongoing reinforcement. You cannot say, we're done with our culture, we've got a program, we've delivered, and that's it. And that brings me to the conversations I want to have with the panel, who I'm hoping are going to share even more insights in terms of what they've been seeing in the industry, how they've been experiencing this, but also bringing a bit of practical examples. But please, I'm not only looking to ask them questions, I'm also interested in your questions in this topic in terms of what is it that you also want to bring and take out. But before I do that, let me introduce you to my panel. Because I'm very privileged and honored to sit with these people, so you've got to understand when I introduce them. So next to me here, I've got Gidi Boni. She prefers to be called by Gidi. So Gidi Boni Tukoko is an executive at the FSCA. She has a very, very big role of supervising quite a number of entities that are in the room. I think DC Fazana spoke to it earlier on. But what I also wanted to share a bit about Gidi is that she's a 2-time Comrades runner. I don't know how she does it. But I also do know that the FSA needs to build her, because some of the attributes of the Comrades runner is commitment, is endurance, it's focus, and it's all the things that I think the FSCA has taught her over the years that she's been supervising. So there's a bill coming. And next to her is Riani Potgieter, who is not new to quite a lot of colleagues in the room. She's an Chief Executive Officer at the Compliance Institute of Southern Africa. She's also a chartered accountant. And I have to share this with you. She believes in the power of being inquisitive and staying hungry for new skills and knowledge. And she believes in the greatest gift that we can give ourselves is that of being agile and awake. But one thing that all of you don't know about Rihanna Potgieter is that in her younger days, she used to sing opera for pocket money, and I'm hoping that we'll have time, MC, that she can give us that rendition. The last panel member that I have is Begim Kize, a family member who worked 20 years in the industry, and thank God, finally, I think the light bulbs were switched on, because she came on the side of the regulation. And that's where she is. He's been here with us for 5 years, and he's also a chairperson of a governance working group for the IAIS. I was tempted to ask, I don't have time, if we know what is the meaning of IAIS, what does it stand for? I'll keep that for later. But he's also a jogger. I'm saying it very softly, because I do believe that Gidi will have to coach a bit on the other side. He's not into the running as yet. So that's the panel that is going to help us answer some of the questions that you have and some of the questions that I've prepared. So Gidi, just listening to what Lizanne was speaking about, listening to the commissioner, to the governor earlier in the morning, I think it's very clear that culture and governance, it's not just a supervisory requirement, But I think it's an absolute necessity for the entity's economic and social sustainability. But I think it's also important to note that culture as a concept, it's a very complex concept. It's got quite a number of multidimensional elements that can influence the financial institution as well as influence the customer, whether positive or negatively. I just want us to share with us what has been your experience in the engagements you've had with the sector. How have you experienced this? Where is the sector? What levels of maturity are you seeing? But most importantly, I think the audience will agree with me on this one. What does FSCA expect to see when they go out and engage these entities on this topic?
Thank you, Cindy, and good afternoon, everyone. Thank you so much for coming and to share with us these difficult topics that we decided to have today. Cindy, before I get to your question, I think there are several points that I've picked up from the Commissioner's introduction, from our Deputy Commissioner's dialogue, from Lizanne's presentation. For me, what I thought was really profound was that from Lizanne, she said, effective governance is very critical for the success, for financial soundness of the institution, and also to make sure that in all of this, the treatment of customers is ensured. Number two, when we look at the governance of an institution as the FSCA, that is our heartbeat. And as we heard, it's also a heartbeat for the Prudential Authority. So there shouldn't be any expectation that this topic is only relevant for Prudential Authority and not for conduct of the Financial Sector Conduct Authority. There were certain elements also where Lizanne said that governance includes principles, it includes processes, but also it includes behaviors. And these behaviors are the drivers of how organizations are being controlled and being directed. It's also critical to learn that this is the role of boards and their responsibility to ensure that they set up a tone, as you said, Lizanne, with regards to the culture of the organization. They establish the strategic direction, and on top of that, they make sure that the culture of the organization is what they would like to see from top to the bottom. Now, I also heard Lizanne saying culture is a driver of conduct. And I agree with you, because effective culture means that we will see behaviors from management and the staff members about their day-to-day activities. And an effective culture is the one where we see that there are expectations and also there's a drive to ensure that there's a consistent application of putting the customers at the center of any decision making, of any product design, and in all daily activities of management and the staff. Now, coming back to your question about our journey with the industry, it has been quite a beautiful journey. When we started from 2018 as the conduct regulator, it was a mammoth task for us to go and talk about conduct risk and to also convince our financial institutions that this is the way to go for the industry. When we look at the financial sector as a whole, there were variation of maturity in the sectors. Some of the sectors were already identifying conduct risks. In certain sectors, they were thinking about identifying those risks. And some of the sectors were just waiting for the regulator to come and tell them what to do or how to do it. Now, with the journey, when we started engaging with the boards, when we started engaging with management, we realized also that the topic about conduct was not as familiar. And I'm not saying it was a bad thing, but we understand that it was a change that needed to happen, especially because the previous regulator, the Financial Services Board, was all about compliance, compliance, compliance. Now, we cannot just expect a switch to now looking at the conduct risk. But that was the crux of the challenge that we were faced with. Looking at the structures of the organization, the board did not have any further information that will highlight the risks that were threatening the good outcomes for the customers, and they were not even tracking the trends that can lead them to realize that there are issues at the bottom of the organization. There were no training for staff when we talk about the conduct risks to the lower levels of the staff members. They were not aware of what should be happening and how it should be happening. But what was positive about this journey at that time was there was a willingness from our financial institutions to adapt and adopt this conduct risk assessments. I know, Lizanne, you mentioned that there is no good and bad culture, but there is a way for us as supervisors where we look at what would good culture look like. And from me, as the supervisor, I'd say good culture looked like how our customer's point of view is looked at. If there's a product on the line, as a customer, does it suit me? Does it give me the outcomes that I'm looking for? And if it does, then I would say, okay, then it means from the financial institution side, their aim was to have a good culture with this product, and as a result, it will give a good outcome to their customers. Not all the products will deliver as planned for, but that is a question that we always ask and we always look at. Coming to the expectations, yes, it's still a journey, and I'm happy to say that Commissioner outlined some of the achievements that we are seeing today. Conduct is a word that is being said in board meetings, and also there's evidence that it's been tracked, there's been an oversight from the board side down to the lower levels. We continue to see and to drive for continuous improvements and enhancements to make sure that our staff are being trained, to make sure that there are channels where staff members feel comfortable to go and report culture and conduct issues, and they feel safe about it. We also expect to see how our board members are looking at the complaints and value complaints as the gold for them to see opportunities of how they can gain, how they can provide excellent service to the customers complaining, and also build the trust from the same customers who have been complaining. And as we are saying today, the industry will be trusted from the customer's point of view. It's not an easy journey, but I believe that collaboration, as you said, Lizanne, it's the one that will help us with the industry to make sure that we continuously strive to give good outcomes for our customers.
Thank you so much, Gide. And I think a theme that was coming out strongly as you were talking was change. So the sector has been going through change. Earlier on we heard from the Commissioner that it's really a change from not just being compliance focused, but ensuring that the conduct is now a business imperative. And that brings it to you then, Rian, in your industry, because I think it's becoming quite clear that the industry has to change in fact, in an accelerated format. And I do believe that the compliance have a very, very important role to play in restoring this public trust and inspiring the trust that we are speaking about today. So in your view, how has been the emerging shift been like in the compliance world from the traditional compliance way of doing things into this new ethical culture, outcomes focused, and how has the compliance community, taking this, what's the feel, what's the touch on the ground, and what can you share with us in terms of some of the things that you've noted on the ground?
Thank you. I think if we're talking about trust, how do you create trust? How can the public know that they can trust a financial institution? It is about communication, but it's also what I say and what I do, but how it is received and how it is understood by the audience that we are trying to engender that trust in. So, the best way, if you want to commit to something like this as an organization, the first thing you would do is to actually say it, to commit publicly to this. If you're going on a diet and you want to make sure that you're held accountable, tell people. So, tell people you're on a diet because they're going to watch you at lunchtime if you're going to have that piece of cake, right? So I think that is quite important, is to be vocal about it, firstly. But of course, if it's not supported by action and the visibility of how that organization is operating, then that is also empty words, and there will not be trust generated. As for, we speak about traditional compliance versus where we're going now, I think I would actually like to, it's one of my bugbears actually, can I say that? The traditional compliance, we have been as a compliance community and as a compliance institute, have been for many, many years in our generally accepted compliance practice framework, have been promoting the risk-based approach to compliance. So it is not a new thing for us. It's actually quite a small step for us to make that jump, if a jump at all. However, I think what I am going to say about compliance and the compliance community and how do we look at it as an institute is trust the process. Our GACP, the Generally Accepted Compliance Practice Framework, has really stood the test of time. We've just gone through a review of that, and most of the principles, there were only 2 new principles that came in, and one of them was outcomes. So I think the outcomes-based legislation and where that takes us to as a community and as a, not just compliance, I'm talking about South Africa, is to understand that there is something that we want to achieve. The regulator and the regulators, or regulators and the regulatees, if I can say that, we should be in a dance, right? Now, if you're getting onto a dance floor, what you expect from your partner is there must be some pressure back, right? You can't dance with somebody and do the right steps if there's no counterbalance. So I think it's very important for organizations to then say, you know what, we're serious about this, we're serious about governance, we're serious about culture and compliance. We meet the regulator where they're coming from. And so you don't have to give us regulation. We're not waiting, that point has been made a couple of times. We don't have to wait for regulation to do the right thing. We are already putting in the governance structures. We're already taking that accountability as a governing body. We have the necessary resources. We're serious about this. We'll put our money where our mouths are. We support that compliance department. We support risk management. We have proper governance structures. We ensure that the governance principles are there, of independence, of the necessary status. Because those are the things that are translating into that external world. They look at this organization and see, how are you actually doing this? You say you're serious about compliance, but it's not on your senior management team even. There's no representation there. That's a serious indicator. So, so I think that it's the outcomes-based, one also needs to be cognizant of, not everybody's at the same level of sophistication and understanding of what is an outcomes-based legislation. If you're talking to large, sophisticated corporates, I think there will be a very good understanding of that, but I think we also need to adjust our messaging depending on the audience that we're speaking to, and that we want them to understand that this outcomes-based legislation, what does it mean in your life? And actually what it means is, we're going to protect you. They want to hear words like that, words that they understand, that resonate with them. Don't speak academic. Speak
human. Yeah, really, and I think just touching base to what Gidi spoke about, she spoke about the journey, and I think you're bringing that in as well, that this is a journey. And I think we've got to be patient with each other as we navigate this, because we all have one goal at the end of the day, to ensure that we do right by the customer. But also you spoke, there's a theme that came out of communication. There's a theme, and I like this one, the dance floor concept. And Beggy, that takes me to you. Let's go to the dance floor. Because I think one of the things we are always conscious about in the regulatory community is that we don't duplicate efforts. We don't go to an entity today and regulator one has gone today on the same topic, and tomorrow regulator B goes and discuss the same topic. And I think just listening today, it became quite clear as well that the issue of culture, governance, and accountability will impact, without a doubt, both the prudential and the conduct regulators. And in the past, it's also important to note that these were assessed separately. And I think it was DC Kate who mentioned the date 1 April 2018 when the FSCA came in. So before that, these were assessed separately, which then potentially could lead to duplication of efforts, as I said, and worse off, gaps in areas where there is overlap in mandate of regulators. And tomorrow, please do come, because I think that will be quite important, because there is a panel discussion on inter-regulatory collaboration under the Twin Peaks model. But in the context of today's topic, I want you just to share with us, how do you see the two regulators collaborating on this topic? How do you see that working out?
Thank you. Thanks, colleagues, and thanks, Cindy. I think particularly to the Commissioner and his exec for inviting us. So I also see some familiar faces on the room, so it's good to see you. Contrary to what was said earlier on, my previous employers are still previous employers, despite my suit. So I think the short answer is communication and collaboration, right? And I think if you look at the governor's address this morning, me sitting on this panel, and there are various colleagues from the from the SAB and the PA that are present. That in itself is testament to the message that's been sent from the top. So we are sending the right tone from the top that says that conduct issues do impact prudential matters, right? And there is a dance that needs to be done. But also picking up on an issue that you just shared around there needs to be maturity and patience in terms of what needs to be done. These institutions are still quite young, and as a result, it will take time to get to that point. So if the question is, can these institutions work closely together? Yes, without a doubt, and we should be trying to do that. So there are a few things that maybe we have been doing. So one is around collaborative supervision, which we have been trying in the last 5 years to see how do we align some of our supervisory planning, how do we identify matters where there is common interest, and one of them is issues of governance, culture, and accountability. Because I think everyone sitting in this room, I will admit that this topic is relevant for all of them. It doesn't matter what is the size or what industry you're working on. These are three topics that are important. So collaborating at a supervisory level is really of importance. We have started doing that. We can do more. Lezan touched earlier on also on the joint standard that is being worked on. I think that talks to the theme around collaborative policy and standards development. You are quite aware that if you have to look at the standards, policies that you need to adhere to, you go to the FSCA website and you go to the SAB website, right? So we're trying to find a way that some of those could be similar, where there's topics of interest that could be useful. So we have tried to address the issue of not going to one institution twice for the same kind of questions. And you'll find that there are some meetings where, and the colleagues in the room will attest to this, you'll find the PA and the FSCA for what may have been traditionally been a SAB meeting or a PA meeting. And on the other side also you'll find the colleagues from the PA accompanying the FSCA to be able to touch on that. So I think those are the things that I wanted to reflect on and say there are ways that we can make this work, and I think there's the right tone that's been set from the top. The one thing that I think we still need to work hard on is how do we align our taxonomy. So sometimes we say we mean the same thing, but we say it differently. And I think it's fine for us within the PA, and it's fine for the colleagues within the FSCA, but when you go to industry, we sometimes confuse them. And also it just makes sense because we are birth of the same act, right? It's a FSRA act that gives birth to us. So I think some of these things that I've touched on today, we are not sending the governor and the commissioner to parliament. There is no changes to the FSRA Act for us to be able to employ this. It's just really the appetite for the people that are sitting in this room and sitting in the right higher echelons of the two institutions to be able to implement this. And I think there is appetite to do that.
Thank you so much. Thank you so much, Peggy. And I think if I'm listening to you on the issue of collaboration that's already happening, I couldn't wait by thinking, how will it look like in the next 5 years? Can you paint a picture for us? Take us to 5 years from now with what Peggy has shared, with what Rian has said, and with the journey that we have experienced. How will the sector look like, and how will we be engaging on this topic in the next 5 years?
In the next 5 years, I think the greatest measure for me would be the customers.
Okay.
From the customer's point of view, do they understand what they're buying, what they're getting, where to go when they have issues? When they complain, are they taken seriously? Do they trust the financial system as we're trying to make sure that we bring them along in this journey and make sure that we always look at the outcomes for them? So in the next 5 years, I'll be happy, and I would have achieved my journey and vision when I hear a customer is free to complain and trust that there's someone who's going to listen and do something about their complaints.
And that's the challenge to you, colleagues. Hopefully we'll meet again in the next 5 years. And Rian, I think just in that context and that same wavelength from what Gidi was talking about just now, the compliance function, how do you see that shaping up going forward? And what are some of the key takeaways that the colleagues in the room should go back and really start preparing themselves towards or gearing themselves towards for the future?
I think hand in hand with the outcomes-based, there's this whole discussion around principles versus rules-based. I don't think it will be an either or, it's probably always going to be a hybrid. But I think the principles-based is probably going to be the challenge. Because it's easy to talk about it conceptually, it makes a lot of sense conceptually. To implement it practically is where it's going to, it's going to be difficult. And also the larger your organizations are, the more you have to really then put in rules in place internally. And I think that is really where principles-based legislation is going to, is to say we're putting the onus and the decisions around how to manage my risk internally on the organization. And that's going to take a lot of doing to get that implemented in an organization. I think from a compliance function perspective, many of the tools already exist. I really trust our process, our compliance process, risk identification, measurement, management, monitoring, all of those steps. I really trust the process. I think what will change is the how. And for us, if we talk about what are the changes that we need to think about in a compliance function, the skills of our compliance officers, but also of our organization's people. If we just, principles-based legislation, outcomes-based, that is but one of the sort of trends, I would say, globally right now that will have an impact. What about AI? What about ESG? What about all of those other mega trends that are also going to have this impact on compliance and organizations, therefore on compliance? And I think we have to think about the skills that we have to have are going to be much more behavioral orientated. Soft skills, if you want to call it that. I don't believe that there's really anything like a soft skill. These are skills that you have to have in the new world. It's the inquisitiveness that I've mentioned to you. It is that hunger for understanding what is happening, understanding it to a good enough degree that I can make good decisions and on how my approach should differ. So the skills component for me is really quite an important thing. And then, of course, just getting and get tech savvy. You know, the world that we're moving into is going to be so tech heavy that if you don't have a very good basic level of working knowledge and understanding of that, I think we're going to be lost.
Sure. No, thank you, Rian, for that. And I had to steal from what you believe in, and I just became quite curious, Peggy, and quite inquisitive in terms of what international developments can we expect? I mean, there's a lot already from the panel in terms of what you should look like. But from an international point of view, what developments are playing out in that space?
Yes, so I mean, you have shared earlier on that I'm wearing two hats here. So what PLZ builds is working for the SAB and the PA and doing prudential supervision of these fine institutions. But also I represent the SAB at the Institute, International Association for Insurance Supervisors, which really does the same as what the BIS does for banks. So we issue core principles, ICPs. There's 27 of them, which really guide member countries to say what they can consider to put into regulation. So there's a lot that's happening in the space. But if I just go a step back in terms of what we're trying to do with the topic of culture, governance, and accountability, in essence, you know, the scholars in the room may tell you that, you know, particularly when it comes to issues like governance, governance has many definitions, but it can also be considered as a control, right? It's a control for a gap, which was raised earlier on, or a conflict, right, that may arise in many stakeholders. So it can arise from shareholders to boards, you know, board to management, management to staff, and regulators to institution, right? So if we agree on a certain point on what we expect from the institutions, we can then try and address that. That's what we're trying to do with corporate governance. So in the international space, we try and identify areas of developments around these issues of governance. So in the local space, Lazan has touched on the joint standards that we're working on, which we're hopeful that it can come into play quite soon. As early as 2015, on the banking side, the BIS, the Basel side, issued core principles on corporate governance for banks. Now, we agreed earlier on, even though I didn't get your consent, that this really is across, right? If you agree with that, take a look at that paper. It's a 2015 paper on corporate governance. I promise you it's relevant for all of you. As recently as last year, I think Q3 or Q4, the Basel also issued a paper on corporate governance on fast payment systems across borders. We know what is happening in the cross-border areas. And then currently, in the insurance space, and Lazan has been leading the charge in the international space, where we're working on an application paper on a very interesting topic on diversity, equity, and inclusion. What you find is some of the countries are further ahead, but what you also find is the countries that you think are further ahead are actually slightly behind on some of those things. So we started with a stocktake report in 2022, where we really issued a paper on what do we consider as DEI in the insurance space, what are some of the definitions, where are we in the industry, and that was a member only. And then it advanced to this application paper now, which has just recently been approved by Exco of the IAIS. So please be on the lookout for that. You will have 90 days, industry and everyone, to provide input on what you think can assist us. And in this paper, we really are trying to give you know, supervisors some cues on what you should be looking out for when it comes to issues of diversity, equity, and inclusion.
Thank you, Peggy. Thank you, Peggy. And I think it's the opportune time for me to open just for a few questions. We cannot let them go without answering some difficult questions. If you can help me with Mike, there's a question there.
Good afternoon. Hi, good afternoon, and thank you, panel, for the insights. My name is Shabnam. I had a question that really links to the discussion that Becky introduced. So I think that across the regulatory bodies, we obviously see strategic priorities, different roadmaps. There might be similarities, but also competing priorities. we mentioned commitment around collaboration, communication, and ultimately, as per the Commissioner's opening, all of that goes a long way to instilling trust. So I guess my question, and Becky, I'm not sure if it's an unfair question to you, so open to the panel or to the Commissioner, but just in terms of practically, how do we manage that dialogue? And when I say we, I mean particularly FSCA, PA, SARB, on a day-to-day practical level, how frequent are those engagements? Obviously, an initiative like today is a fantastic opportunity to collaborate, but outside of that, if you could share any insights. Thank you.
Thank you so much for that question. If I can take another question before, I think there's another question there before we answer.
Hi, I'm Calvin Christopher from Standard Chartered Bank. A very similar question to Shabnam, also for Becky. Just, I guess, to follow up on your point, one of the items that we work through in the banking sector is the Operational Risk Maturity Assessment Questionnaire, which we work with on the Prudential Authority side. It's very helpful for us internally as we benchmark ourselves against regulatory expectations around conduct. There's a component around risk culture. And I guess, is that an example of something, is that shared with the FSCA? Is that an example of how we can leverage in this collaborative supervision model, particularly to Cindy's point around avoiding duplication and Rihanna's comments around aligning taxonomy? Thank you.
Thank you so much, Calvin. Okay.
Because many of the big items, institutions, actually in some form or another, as the Commissioner and Governor indicated, should be of interest of all the regulators. Mm-hmm. So that's my perspective. Okay. I just had a question. We discussed technology and new technologies, subsequent sections. Institutions are also bringing in different types of people at a board level, senior management, but deeper in the organization as well to respond to these technologies. That's influencing the culture of the organizations as well. Mm. Traditional cultures are also changing and getting a mixture of cultures in the organization. What are you seeing in the industry in response to organization bringing different type of people at all levels into the sector?
Thank you for that. I think I'll start with you, Becky, and I'll come to you, Riani, on the other questions. Okay. Hi.
Yes, so if I can, yes, thank you very much. Thank you for those questions, colleagues. So I think there definitely is strategic alignment on priorities. You said we must give you examples. Certainly, from an exec perspective, so the execs of the two institutions have regular meetings, which are in the calendar, formal meetings where they engage on issues at strategic level. At an operational level, there's also regular interactions to be able to talk on policy issues, standards issues, what's on development, and we collaborate at those levels. And then I used the example earlier on the supervisory plan. So on the frontline side, which is the supervision really, that is the people that engage with the institution are really in the forefront. Those people really interact and engage together when it comes to the supervisory plan. It wasn't the case before. It's something that we have started implementing in the last 3 years, 2 years. We're trying to get better at it. So, and we welcome your feedback. So in terms of how do you manage the dialogue, we really do have an open door policy. So the institution that I supervise will tell you that that's what I always say. So if you feel that there are things and issues that we can do better on in terms of alignment, please let us know. If you feel that there's some duplication, we are open to have that discussion. We can't be blind, though, to the fact that we do have separate mandates, right? Where those mandates can be put together, certainly we should. But we can't then, not think about that issue that's also there. You touched on the ops risk question. I think ops risk and IT, if my colleague was here, Jacques would have told you, is one of those issues that are really important. And in fact, there is work being done in that space for also consideration of a joint standard, because it is an issue that is across industry. It is an issue that's not necessarily only financial, therefore not only on the prudential side and not only conduct. So it's one of those examples actually that we have started to do some work on how to identify a joint standard. Some of these issues also, you'll find that the answers to some of those things are in different mechanisms, right? So in the insurance standards, you'll find something. In the bank's regulation, you'll find something. So these actions that we're trying to do is to see how we pull those things together and make it relevant for most of the institutions. I think those are my questions.
If I may add, Becky, the FSR Act also compels us as the two regulators to collaborate, and this starts when we open up and allow entities to come in our financial environment. So the process of when an entity is applying for a license, we have to share the information. One authority has to concur with the other one before we allow an entity to come in the space. And remember, we will be looking at the conduct aspect of the application, and you will be looking at the prudential side of it. So there is that other element, pre-entry to the financial environment. Thanks.
Thank you so much. There is a question that was asked in the front. But because I'm a moderator, I think I can also choose from the floor. And I wanted to choose DC Fazana to answer this question, because Akash was talking about the industry. I mean, there's an evolution into the digital world. And obviously that has influence on the culture, and how are we seeing that playing itself out?
So thanks for repeating the question, because I think I missed it the first time. I'm going to do the same thing I did earlier. That's our next panel, is around digital innovation. And I don't like to take away other people's thunder. So you can, but the one thing I will say, and I think it's quite important to say this, as much as we recognize and appreciate the accelerations around digital, and it's extremely important, it's another value of our outcomes-based approach. It is meant to be technologically neutral. At the end of the day, whether you're investing in technology or not, we need to make sure that the outcomes are fair across the board. However, we do have to see whether even our outcomes framework is tailored or fit for purpose when it comes to digital innovation. And I think that's a challenge that not just we are struggling with, but I think internationally, supervisors and regulators are struggling. We've seen that just in the crypto space. It's not been an easy journey. And once you start talking around AI, DLT, etc., it becomes a lot more complicated. But again, I do hope you will ask that question to the next panel as well. Thanks.
Thank you so much, DC. I have negotiated for just a few more minutes, and I just wanted to check if we've covered everyone on the floor. I can't see clearly. Okay. Thank you so much. And thank you so much once again. Please, can you help me just a round of applause for the panel members. We will meet again next time. Thank you. But I think just a last closing words for me is that the transformation that is needed, that we spoke about in the last hour, is a transformation that will require the sector to be morally relevant, to be transparent, to be accountable to all its stakeholders in a sustainable way. And there's a quote I want to leave you with, and this is from Steve Milligan, he's a CEO for Western Digital. And he said, and I quote, "You cannot mandate an ethical culture, and you cannot just announce that you have one. You build it day by day in the countless good decisions that you make, and importantly, in the bad ones that you do not make. You build it when you speak up about things that don't seem right, and when you don't turn away from the things you see and you know are wrong. And with that, thank you so much for your attention. Oh, God.
Oh, I think we could do better than that. Another round of applause. And one more round of applause because we've I love you. Me, I love you. Because I wanted to say we've managed to claw back 15 minutes. So yes, another round of applause. There's nothing that pleases me more than the moderators and panelists, all the speakers who are doing the right thing. They are throwing forward to the next item on the agenda. Stay tuned, there's more coming. So you heard from this panel that we're going to be discussing all the digital developments, particularly AI, and all of the issues that were raised here today will be addressed there, or at least some of them. We're also going to be chatting about crypto assets. Now with that, please can I upfront say, we are not going into a whole deep dive around crypto assets. I do believe the FSCA has been very, very upfront and vocal around giving updates on where we are with that, how we are regulating them. And so the intention of today's conversation is to just give an update to you because obviously this is a developing story. So give an update and give you a chance to ask one or two questions. And so we won't have a whole panel discussion around that. And I'm not expecting lots of questions because then we will refer you to our website. Now we're going to take a short break. Well, it's not a short break, it's our lunch break, but I'm saying short because I'm hoping we'll be able to keep it slightly shorter than what's on the agenda, and then we can make up a little bit more time. So the time now is 10:02. Can I please ask that you indulge me and we can be back here by 1:30? Is that doable? Did I say 1:30? Wait, 10 to 1, 1:30. Yes. 1:30, back in the room, please. Thank you so much. Welcome back, everybody. I hope lunch was to your satisfaction and to your liking. We tried to keep it light so that it wasn't starch heavy. We had reasons for that. So that in the sessions that are coming up, we have you still wide awake. There was a method to our madness. So, slight change to the program. We would like to take the two panels that we've got left for the day back to back. So move the sustainable finance conversation to just after the AI discussion, and then end with the crypto discussion. Everybody in the room that's in agreement with that, please say aye. And then you wonder why I love you. You don't wonder, you know, ne? Ah, my people. All right, so for the next discussion, we are talking about AI. And I can vouch for everybody that's coming up on the stage, none of them are robots. Everyone is who they say they are. So the way we're going to do this is, first up, I'm going to invite our senior fintech specialist, Nolwazi Hlope, to just give, again, an overview, a presentation that frames the upcoming panel discussion. And then once she's done, she will then ask our CIO at the FSCA, Ms. Pukeng Mohase. She will be moderating the next panel. So CIO plus the panelists will then come up on stage. They have their conversation and take questions from you. Again, I would like to appeal to you, because we are trying to claw back some time, please can I ask that you keep your comments and questions fairly succinct so that we get straight to the point and we're able to accommodate a few more people. For the online audience, by the way, I didn't mention, we've got hundreds of people that have joined online. So even though in the room, we're not as many as what you might think, online we have a whole lot more people. So thank you so much for taking the time to join us for this discussion. Online audience, if you would like to ask questions, just another reminder, events@fsca.co.za. We are already receiving a flood of comments and questions, and we will address every single one. We might not do it right now, but we will get to them. So please keep those coming. For now, please put your hands together for Ms. Nolwazi Hlope.
Good afternoon, everyone. Sit on. Good afternoon, everyone, and welcome again to the conference. Is it on? There we go. Good afternoon, everyone. As I've been introduced, my name is Nolwazi Hlope. I'd just like to welcome you again today and get started on my presentation. So today I'll be talking to you about AI in the context of the financial sector and consumer protection. So one thing that's key to think about in our discussion is, why are we looking at this today? Technology is something we cannot ignore in the financial sector. We've already seen advances in blockchain, in artificial intelligence, as we're seeing today, also in other advances as well. So we cannot ignore the scope of consumer protection, because as a market conduct regulator, that is what we're worried about. But before we get started, one thing I think is important to consider is, let's get our definitions together and think about exactly what is AI, or what is what we've understood as traditional AI, because all of what we know, what is generative AI, is still AI, and what we know is large language models and natural language processing and machine learning, all of that is AI. So traditional AI, as we've come to know it, is basically getting a computer to do the job of a human. So traditional AI is what is known as models that do pattern recognition, classification, or prediction. What a normal human can do, but at advanced levels or using big data, but classically if you bring it down to the human level. And therefore then, let's think further. What is generative AI? Everyone went crazy when OpenAI brought forth ChatGPT. We all got excited. Oh my goodness, I can talk to a computer. Tell me a poem, tell me a story. Let me see my favorite movie. Do you know what it is? And then it shows you a movie, maybe it's not your favorite. But I can talk to a computer and it sounds like a human being. But what is generative AI? This takes it, if we think a step further, and it's basically a subset of AI comprising of models that can create new content. So now it's not limited to just what we were seeing in our traditional version of AI, but now you're training the model to use data to create audio, videos, text, code, and images. So now you can go and describe and say, I want to see an image of I have a cat, so you describe an image of 2 cats dancing, and you've got that appearing in front of your screen, and you can download that and save it. But now let's look at our discussion in the financial sector. What have been the drivers of AI disrupting the financial sector? We've seen that big data has suddenly become available in the financial sector. There's a wider scope now. People are transacting more. But then again, in South Africa, we're still struggling with having a cash economy. People are still transacting in cash, and we still need to move them more into using transactional banking. But those that are transacting more. They're interacting with financial institutions more through social media, through other forms of interaction, so that banks or other financial institutions are having large sources of data, whether structured or unstructured. So this is through emails, text messages, voice messages, and also images and videos that are more available that they can use. We've also seen that there's availability of infrastructure, computational power that is higher and is reducing costs, making efficiency better for processing data, and cloud technology is also available. Also, regulatory requirements have been easier to meet now with AI in the financial sector, because there's been the availability or the opportunity to automate data collection processes. Also now, with competition, AI has become the differentiator. You can now, as a financial institution harnessing this technology, better be able to serve your consumers. You can develop better products and services, or better understand how your consumers are interacting with a certain service or product and design it better. So we're seeing that there are a lot of benefits here. And even now with generative AI, you can build services such as conversational services like your chatbots, where your consumer can interact and have a humanoid or human-like interface talking to them, explaining everything to them easier. There are a lot of benefits to AI, but we'll still discuss the risks, and that's coming. There are a lot of use cases also that we're seeing coming from the results of the drivers. So a lot of productivity enhancements. We see compliance and reporting, which is some of the use cases that are coming ahead that we'll discuss. We see that there's a lot of other enhancements that result from the use of artificial intelligence and your generative AI in the financial system, not only in banks, but other sectors as well, insurance, payments, whereas though banking is the leading sector in South Africa with implementing this technology. So we see that you can see AML CFT. This is where you can see with transaction reporting, suspicious transaction reporting, where this is growing now. And how do you see this appearing in value creation, in new product development, in customer support? But how does it look like in customer support? You see that they're your chatbots, your voice assistant, that come about, and your customers engage with this. So let's look at what's happening in South Africa regarding our new technology. So in our trends, over the past year, discussions about AI have increased by 370%. This is just AI in general. And that should say a lot to you in the fact that this is why we cannot ignore this discussion. And 60% of South Africans said they were excited about the possibilities. So they're looking forward to this technology growing, and they want to see what will happen. And banks are the leading in the sector and the financial are the leading financial institutions in the financial sector who are employing or deploying this technology. But other segments are as well. We see this in payments and insurance, where I'm doing quite a bit of research on insurance that are rising, and also fintechs who are using this technology as well and using it through unstructured data. So let's discuss some case studies where one of my fellow panelists is a part of in F&B, and we'll give further information on this case study, where they've been using AI to improve their customer experience, using it for regulatory reporting, and also to combat fraud and improve risk management in the form of when customers sign up, they use AI technology to review the documents before the customer can be accepted. So the documents are reviewed and assessed and accepted before the fact instead of after the fact, and then the customer can be accepted or rejected. So the AI systems are also used for regulatory reporting to increase efficiency of their staff members by up to 70%. And you can see the power of this technology. One interesting use case in Nedbank of generative AI is the fact that they've implemented the Microsoft 365 system of Copilot. So what does Copilot do? It is your Copilot. Copilot works with you in everything you do, just sits on the side, and if you're working, what do you need help with? Imagine your ChatGPT 4, but as your help for all your Microsoft 365 apps, plus extra. You ask your questions, hey, how do I do something on Zoom? Hey, please help me code this on SAS, on R, on whatever. Please help me, I don't know how to do something on Chrome. It is your productivity tool to help you with everyday life. And by not any means am I endorsing any of this. I'm just highlighting the benefits of this technology. So now, let's move on to our discussion on the consumer risks. And remember, as much as we are excited about this technology, we can't forget the importance of protecting our consumers. At the end of the day, if our consumers do not trust the financial sector, as the Commissioner said, they need to trust the financial sector in order to have confidence in the financial sector. So we need to ensure that they are protected so that they can trust the financial sector and have confidence in it. So what risks do we see arising from a consumer protection point of view? When we look at the first or the most obvious risk, we see that there may be a risk of bias, discrimination, or unfair outcomes. So how do we see this? First of all, artificial intelligence has the capacity to unmask anonymized data. So seemingly anonymized data can be put together, and then you can see that, oh, this is Phokeng's information because she seemed to, it links here that she seems to be working at the FSCA, CIO, maybe likes jogging in the afternoon. This comes together, it's Phokeng. And then the profiles come together, and maybe it links up that this type of population of people are like this. And then it ends up being a form of discrimination. And when we're looking at insurance claims or insurance premiums or insurance premiums, for example, there might be bias against them, and their premiums might end up being higher than a certain other group. And then if we look at lack of explainability, you see that in AI models, certain models are trained to be supervised and other models are unsupervised. So the supervised models are easy to look at and explain and understand how they were built. The unsupervised learning, not so much. And then when it comes to that, you have a problem of lack of explainability. And you can see my other points there as well. But now, when it comes to the unsupervised learning, then it becomes a challenge to explain how your model came to a certain conclusion. And that becomes a bigger challenge when you look at your generative AI, because that is not completely unsupervised. It's semi-unsupervised. And then how do you explain your outcomes to your consumers? How do you tell your consumer that your claim was rejected because of so-and-so a reason, or your loan application was declined because of so-and-so a reason? And that becomes a risk as well. And then when it comes to data privacy, certain AI models can have access to private information, not because of, I remember you mentioned that there's certain data governance models, but from research I've seen that with this particularly generative AI models, if they don't have appropriate data governance in place, can have access to private data, confidential data to develop the new information that they create, and there's no appropriate way to reference it, and they can recommend that to you. That is a risk to consumers, particularly when they're now receiving investment advice. How do you now come and reference that and say, now you gave me inappropriate investment advice and I'm losing all of my money? How is that clawed back? And lastly, when you look at competition, if we have a lack of competition in the market, there'll be fewer providers using this technology. What incentive do they have to ensure robustness of their AI models in the system? So this is just a teaser of the consumer protection risk, as we'll discuss more of this in our panel. And so as I close off my discussion, I just want to look at what are some of the regulatory considerations and supervisory considerations, as well as considerations for industry as well, because this is a multi-stakeholder discussion. It is not just for regulators, but industry should be involved as well. So consumers have certain rights. We all know about the Consumer Protection Act. And under the Consumer Protection Act, our consumers have the right to equality to the consumer market, to the market and protection against discriminatory market practices. Consumers have the right to privacy and disclosure of information, a right to lodge a complaint, and the right to fair and honest dealing. So in our first right, to try to mitigate against risks arising towards that, regulators can consider risk management frameworks. And the right to privacy, regulators can seek to ensure and promote data governance and accountability mechanisms. And the right to lodge complaints, interregulatory collaboration is key, because AI is a new sphere, and there currently isn't a body that exists for this kind of a right to complain for consumers. And in the right to fair and honest dealing, this touches on the vulnerable consumers. How do we handle the vulnerability of consumers? Because we need to go and raise awareness, and I think taking it a step further, and being deliberate on consumer education and making sure that people understand what is going on in AI and they know what they're getting themselves into when they get exposed to this technology. So when we look at the considerations on treating customers fairly, the FSCA has a TCF principles. So looking at the risk-based approach, one example that where they applied this approach on AI, we see that the EU has an AI Act, where they in applying this approach, they look at different rules for different risk levels. And they are also technology neutral, where they apply it looking at minimal risk to unacceptable risk of AI. And South Africa could consider that. We also need to have clear requirements for accessible terms and conditions, and the further requirements have suggested. And one key thing is that, consumers need to know when they're engaging with AI. It shouldn't be shouldn't have that practice where a consumer doesn't know that they're engaging with the chatbot, so that they have their expectations set that, okay, I'm not talking to a human being. And lastly, what can industry do? These are the principles from the OECD on responsible AI, but what do they mean to industry? Inclusive growth and sustainable development and well-being. That means you should develop AI systems towards positive outcomes for consumers. That is that responsibility. Human-centered values and fairness. AI systems that respect the rule of law throughout the AI life cycle. So that means the right to freedom, the right to privacy and data protection, non-discrimination, and equity. Those risks that I listed before, to avoid them, that is your responsibility as well. Transparency and explainability, to foster general understanding. So consumer education is also your responsibility. Understanding of AI systems. Robustness, security, and safety. Lastly, accountability. So you should be accountable for proper functioning of AI systems. Thank you. I'd like to invite the panel onto the stage.
Testing. 1, 2.
I think it won't be safe for the conference. I might get fired afterwards. All right, so don't tempt me, because I do like singing, even though I'm vocally wounded.
What?
When I saw the program, I was a bit concerned because we were straight after lunch, and I was thinking, graveyard. People would have had the most stunning lunch, and they have to come and listen to us. And so I decided I need to build a case of why you're not allowed to fall asleep, all right? Why you should be paying attention. And the reason is because the panel that I have today are people with really point of views that I think you want to hear. And if you sleep, you lose. All right? I think it's gone. All right. The other thing that I wanted to highlight, yes, we're going to be talking technology, all right? But in the world that I live in, we do have backups. We do daily backups, weekly backups, monthly backups. We've got disaster recovery plans and stuff like that. So yes, we do technology. We also do backups. All right? So do not be surprised that you're seeing some paper shuffling here. It's just for backup again, you know? All right, now here's your reason why you should pay attention. I've got Ayanda Gabecha. So my Zona tongue, did I get it right? Kind of, sort of. All right, forgive me. Ayanda is the Director of Data and AI at Microsoft South Africa. He does have a point of view that you actually want to listen to. So Ayanda, what I found very interesting is that he's quite passionate about advocating for the responsible and inclusive use of AI, something that each leader, each practitioner, each compliance officer should be in the know about. And Ayanda holds 2 master's degrees. So his point of view, you may want to listen to it, all right? Trust me. And then I also have Dr. Mark Nasila. Dr. Mark Nasila is the Chief Data Analytics Officer from FNB. I think it's the Risk Office, am I correct? Yes. Dr. Mark is a professor of practice in AI at the University of Johannesburg. And he's also ranked amongst the top 100 global innovators in data and analytics. That's why you can't fall asleep. You really cannot fall asleep, okay? It's now becoming instructional. It's a command. You can't. All right, and last but not least, you heard from our senior fintech specialist, Ms. Nolwazi Hlophe. You know, they usually say dynamites come in small packages. Can we give her a round of applause for such a stunning? And what you don't know about her is that she's been listed amongst the 60 African women experts in fintech for 2022. By African Shapers. She's also has got a number of projects under her belt and has also been published in the Digital Banker Africa, Central Bank Payments News, and RegTech Africa. Please just check next to you. Is there anybody sleeping? Let's hold them accountable. Help me with that. All right, we're going to start with this. Gentlemen, lady, thank you for joining us. I think the AI as a topic is quite an exciting one. And maybe just by show of hands, who of you have played around with ChatGPT? And the rest didn't know they're shy? Or is the after lunch effect? It's after lunch, ne? All right, so all of us have some level of experience with AI. And why is it so topical? Why do we hear about it so much? And why should we care? Why should any of these people care? Why should they not sleep?
Thank you so much. So the last 15 months or so, AI and specifically generative AI have been topical. Every single board member today is talking about AI. Every organization, every corridor, it's a topic that is being spoken about. Partially because the capabilities themselves are mature. We've got a lot of data today. Scientists have done so much research in maturing algorithms. They can make decisions like human beings. But also, let's not forget the computing power. But there's a different facet to why every leader is thinking about AI, and mainly it's the current reality. And I want to paint a picture on that. When you look at what's happening around the world, we've got geopolitical issues that are affecting every single sector. And we've seen that, for example, when you've got issues between countries, it affects policies, trading policies, and how organizations relate to each other. Then the economies are also changing at a volatile rate. Today, this country is increasing interest rates, another country is changing its economic policies. Then a common discussion is customers of today have expectations. They want personalized products and services. They want their cultural considerations to be put in place so that they're identified for who they are. then technology itself is changing things. Customers today can get the same services by just uploading an app. So disruption is not just happening with organizations from the same industry, but by what we call unicorns. Then there's emerging risks, climate risk. We're talking about cyber risk. There's no day that goes by without a company being hacked today. And last but not least, the legal landscape. Privacy, data risk. At the beginning of this year, the World Economic Forum classified misinformation and disinformation driven by generative AI as the biggest risk, especially with a lot of countries having elections. When you look at this complexity, leaders are seeing AI and generative AI as a mature technology that will help them not only navigate this current reality, but also keep up with providing services and products that are relevant, keeping in mind this, for the first time, we've got a technology that is disrupting all industries at the same time. At the same time. Yeah.
Wow. And I do hope we all got that. It's that kind of technology that you can't ignore. Whether you like it or not, you need to be curious about it, and that's what I'm getting from it. I want to move to Ayanda. One of the key drivers of AI is data. It's very, very crucial to, when you want to drive AI outcomes, data is just at the center of it. For those organizations that want to undertake AI initiatives, what kind of approaches can they undertake so that they don't fall behind?
Thank you so much, and good afternoon, ladies and gentlemen. So I see, I think like Doc said, the interest in AI is there, whether it's civil society, whether it's government, it's business. And the worst thing that can happen in any organization is having a knee-jerk reaction to AI. It's like, hey, everybody's doing it, we should be doing it. Let us come up with a project. And it might sound absurd, but it's happening, right? Because of fear of missing out in terms of the initial gains in terms of customer engagement, customer retention, increased wallet share in a customer. There could be many use cases, right? And back to your point, data becomes the foundation in which to build any AI model on, right? So data is the oxygen for AI. There is no AI without data. Even outside of generative AI, machine learning gained traction and became a de facto standard for predictive analytics and other, pattern identification models, simply because we increased the amount of data that we produce. And we needed machines and computing power, which the GPUs do, in order to compute at scale. And we're computing data. So data becomes, key. And the good thing about AI, or the bad thing, depending on the way you look at it, is it amplifies what's already there. If you are in an organization that has really invested in the right data culture in terms of people, data culture in terms of your data assets from a technology perspective, in terms of governance, in terms of building trust in data-led decision-making, AI will come and amplify what you do. It will give you sound results. It will point you in the right direction, obviously provided it's done correctly. And it will then amplify what you do as a business. If you have challenges with governance trust in terms of data, AI will come and amplify those challenges, right? Especially generative AI, because generative AI, it's creating and generating net new content from what you give it, from your data. Imagine if your customer data or your transactional data has gaps, and you're busy generating net new content to be used as input into your strategy, into further downstream within your organization. You're amplifying those gaps that exist, leveraging AI, and those risks are amplified throughout the ecosystem of whatever you're going to be building, right? So data then becomes key. companies that I've seen in South Africa that have really done well in harnessing power of AI early are those customers and the companies that really pay the school fees in terms of getting their data platforms correctly, in terms of driving that. And we saw it with COVID, right? The companies, when we went into COVID, people that has established the right digital platforms, the right culture in terms of working within the organizations, they weathered those storms a little bit better than people who were starting from nothing. And we're seeing it with AI today. The investment in governance, in building trust, and building an ecosystem of product, and don't forget people and process, are the companies today that are thriving in unlocking initial value from this new wave of generative AI in terms of how they serve their customers better.
Can you hear me? All right, I'm back. Just a follow-up on that one. I just want to be able to give our audience and those that are in leadership roles specifically, what is that first step? You are right about that knee-jerk reaction, or everybody has an initiative. Okay, let's go find two people in a corner somewhere, sit down, play around with this thing. But what do you have to say about the decisions that precede the actual initiatives? Are there frameworks that they need to be putting in place? Are there standards that are available? Is there a one-size-fits-all? What is there for them?
There are standards, and I think it starts with accountability, right? I think like everything in these organizations, when we talk responsible AI, we're talking responsible by design, right? When we talk about leaders making decisions around AI in terms of what to invest on, we're talking a sense of deliberateness, but a sense of ownership as well, right? Ownership of the execution as well as ownership of outcomes at the leadership level. So leaders that are able to own outcomes and also own, that. We've seen, and where really we've seen successes is where you start to establish, and many companies have a different flavors and on it based on their structures, some form of center of excellence, right? That will begin to define, the structures necessary to guide the build and guide how this fits into the broader strategy. And the people that are really successful are the people that says, how does AI begin to accelerate our strategy that we've done? We have a strategy, we need to accelerate, we need to make good on it, and where do we plug in technology to come and help that? But I think what we always need to be mindful of is that we remain in control. So we make the decisions, we drive the accountability for those decisions, we make the investment, we define what success looks like. So knowing the end from the beginning is very, very, very critical and super key in order to drive accountability. I've seen organizations, and I'm a former techie, I'm still a techie at heart. If you leave it to techies, they will go down a very dark path, right? And I've seen this. I've sat in planning sessions with techies, and you give them these new tools, and their eyes light up in terms of what they can do, right? You're like, okay, who's going to hold them back? And actually lay the ground rules in terms of what we can. So just because we can do something, it doesn't mean we must. Right? One author, for example, in our organization authored a book called Tools and Weapons, right? That the same tool can be a weapon.
True.
You decide in terms of what it's going to be.
Yes, I totally agree. You know, I listened to Lizanne's presentation, that segment where they were talking about governance and culture. And one of the things that she highlighted was the fact that as the FSCA, we've started looking at the principles around the use of AI. And I know you've spent a lot of time, Noloazi, in research, and in your presentation you were starting to touch on what are some of those things that regulators can look into where data is concerned around privacy, explainability. Can you touch a little bit on that in terms of, because I think it would start giving insights to the sector in terms of, especially those that are already ahead and have started with initiatives for AI, to already think about what would the regulator look into?
Hello?
Yeah.
Hi.
Okay. Thank you. So I wanted to talk about further around data privacy was because, you know, as Anna was saying that if you don't build your data governance principles properly, your AI models or your generative AI models will, if I can say, run wild, because then they'll have access to information that is copyrighted or behind firewalls and start building that information around giving consumers advice that is around, or that is misinformation or that is disinformation. So data privacy is a big concern, especially in the financial sector where we consider the stakes to be high. So I know that, I remember Lizanne mentioned that there's a development of the joint standard right now. So such considerations would need to be taken because there need to be data governance standards taken into place. And I remember I put that in my slide, and also accountability standards as well, because as much as you mentioned that they select what success looks like, we also as regulators need to give them what success looks like, so that measurement isn't only upon industry, but we also know what success looks like and we understand what the technology means, and we give them also that metric and that measurement. The same way under the TCF principles, we've got to measure yourself under the TCF framework.
Okay.
So, yeah.
Yeah. No, thanks for that. I'm going to pause that response here. We do have Q&A, and in the Q&A, we also have some of our regulatory colleagues that are in the audience that we can pull from. So don't hold back on your questions. What's exciting about the technology is that it does promote exploration and experimentation. So we can start experimenting even on the views around how regulatory should what regulators should look at. So you are invited to experiment during Q&A. All right, let's talk responsible AI, Dr. Mark. You know, if I counted how many times I heard the word trust the whole morning, from the governor to the commissioner to all the panels, there's not even a single panel that hasn't spoken about trust. So especially, we live in an environment where misrepresentation and stolen identity is a factor. We've seen scenarios where AI has given organizations wrong advice. We've seen AI models that have discriminated against certain people because of race and even gender. So from a responsible AI point of view, how do we protect consumers from such practices? What does responsible AI promise?
Thank you. So responsible AI ensures that organizations design or leverage AI to design products and services that are not only safe and inclusive for consumers, but also safe for the internal operation of the organizations. Having said that, what does this mean for yourselves as regulators? Because I'm sure you're wondering, so what's our role? It changes the landscape a bit. The fact that we have AI, one, it changes your scope of oversight, because the financial institutions need technology to be able to keep up with this complexity. So you obviously have to encourage them to adopt technology responsibly. But there has to be a balance between this and the risks involved. I think someone said, would you rather have a nuclear bomb or have an AI disaster? They said you'd rather have a nuclear bomb because you're going to know what you're dealing with. But AI disasters sometimes can last for generations and generations to come. I mean, you've heard about a case of Wozniacki, the Apple co-founder, who him and his wife went to apply for credit. And the wife, they share the same assets, everything. But the wife was priced a higher interest rate. And you can imagine in an economy like ours, those types of decisions can stay off generations. So you have to have an oversight on which is collaborative on how financial institutions or financial services are adopting AI. And we've vouched for a reflective checklist, not just that by looking at the strategy and collaborating on especially initiatives that affect the conduct perspective of AI, like, for example, bias, ethics, making sure we don't have algorithms that have unexpected outcomes, but the ones that drive accountability on protecting customers from a privacy perspective, especially given that data is the fuel of AI, making sure that organizations provide sufficient training. The way things work without AI is very different, and we want organizations, especially in the financial services, to prepare their workforce in a world where there will be human-machine partnerships. But also responsible AI goes beyond just what's happening inside the organization. It goes outside, because AI is going to change economies. We talked about training and empowering citizens to make sure that there's certain innovations that are happening within the organization that can also influence society and products. For you as a regulator, one, you need to use AI to also keep up with the complexity. For example, you need to automate a lot of functions so that you can repurpose people to focus on tasks that require thinking. That's the first thing. The second thing is AI risks are not, they're very complex and they can be disastrous. So you don't want to monitor and catch them. You need to leverage AI to have leading indicators, to be proactive. For example, have controls around data. If there's an issue with data, you must pick up that early before it goes into an algorithm. Then around oversight, we know very well every organization is struggling with resources. Today, you can have controls in place to monitor every aspect of an organization that involves data and AI. Other than, for example, sampling, which I see a lot when you go to conferences. Sampling is a very common approach to oversight, and it doesn't work. So you need to automate things, allow people to focus on thinking, especially where risks and bias and ethics are so complex, but also drive accountability on organizations being ready to adopt AI, because the cost of AI is actually on what could go wrong, other than just focusing on the positives.
I just want to have a follow-up, and I'm looking to you, Ayanda, because you also the data guy. Practically, how can we prevent bias from these models? How can you practically make sure that you eliminate the bias, the discrimination? And I have a feeling it has to do with data, but let's hear from you.
Yeah, on the contrary, I believe it has to do with us humans.
We the data points, aren't we?
Yeah, so I believe if we acknowledge first that as human beings we are inherently biased, right? We bias, and if we don't catch our unconscious bias, it will be transferred into the models we build. If we don't ensure inclusiveness in how we build models, it will lead to bias. And also, I mean, coming back to your point about data, in terms of data collection, who's generating the data? So we had the conversation recently going back to Gen AI, right? Gen AI, and which is, ChatGPT and many others of these large language models, they depend on consuming knowledge that has been on the internet, everything that has been put on the internet online. It consumes all of that to come to the generated content, right? The challenge there is, who's the producer of the data that's there? Right? We had this conversation in an Africa event where people are saying, if we as Africans are lagging behind in terms of generating knowledge and generating content, and these models are learning from content generated elsewhere, right? Is that not driving bias, unconsciously so, unintended so, into the outcomes that it produces, simply because it is producing its content from somewhere, right? It's taking the data from somewhere. That's the data side of the bias, right? Is that the data that you feed the model in order for it to give you answers, if that data contains bias, then it will be amplified by the model, that bias will come through. But let's get back into then our bias as human beings. Not so long ago, about a year ago, I spent some time in a financial institution locally, talking to tech teams around these technologies. We're breaking this down. I was the 16th person in the room, walking in there, and these are professionals, techies that are building models and risk engines and all of those things, leveraging ML and AI. I was the only black African in that room. There was not a single female in that room. And these are the people that are building models that are being used to profile customers in this diverse country, right? If you don't have diversity of thought, diversity of questions, diversity of backgrounds in the people that are building models, their bias, unconsciously so, will be transferred into the models they build, right? So yes, there is data, there is bias coming from data, but there is bias coming from us as human beings, unintended so, right? So we need to be more inclusive, get people in the room that ask different questions to the people that you used to, right? Get people with different skills. Get people from non-tech background, of non-finance. Get somebody from operations to come and ask different questions. It will help us to catch things that we could not think of, as bias. And also then, it also touches something very key in responsible AI. It touches fairness. Because if you don't try to solve for bias, you can't ensure fairness. If you don't catch it, the fairness of outcomes is going to be there. Similar to the many instances we have of people being charged higher than normal interest rates simply because the model missed something in the equation, or the model was done in such a way that it's not fair. So catching bias and ensuring inclusiveness in terms of outcomes, it's going to result in fairness. If we don't catch it there, then the entire value chain, and then now imagine the decisions that are made from a system that is bias-ridden, that is not fair, and consumers are consuming those products down the line, right? So you're creating problems further down the value chain by not doing things correctly in the beginning.
It's getting trickier. It's getting more complicated, and for the regulators in the room as well, because Nolwazu, where does conduct begin? I think listening to him, if we're regulating conduct, and I'm listening to him, is it at the point that you've sold the product, which is a question that you were actually asking, or does it mean as regulators, when we test for explainability, do we need to be going back into how these models were built? What's your view on that?
I mean, I'll start and then I'll ask for help. But I think it starts at corporate governance. It starts in the culture of the institution, where they implement, what kind of culture they implement. Are they diverse? Are they implementing a culture of diversity themselves? Are they open to also listening to advice of different? How is their board structured? How is their management structured?
Yeah.
Because from there it shows that they're willing to listen to different types of inputs and then that will filter down to different departments and tell you what it says about them and their different, and also to see how is their AI or that team that develops that system, how is it structured, to see how they will design those models. And then you will see from there what it says about the unintended, or the unintended bias that might stem from that. But I'd like to also invite comment maybe from Eugene, or if Kathy's still here, if they'd like to add on.
And Eugene, just be ready for us during Q&A. I'm going to ask you to just touch on that one. I want to address an elephant in the room. How many minutes? All right. We're going to take 2-3 more minutes, and then we'll get to Q&A. Is that okay? Thanks. The elephant in the room, when people hear AI, they're thinking, oh my gosh, there goes my job.
Yes.
All right. And what advice can you offer to leaders, especially on how to tackle this concern? And just to make sure that they alleviate the fear, because the instability as well would play a part if we don't address that.
Yeah. So it goes without saying, every organization needs AI, but we have to humanize the adoption of AI.
Mm.
And you need people to implement any strategy. I think when we look around the world today, not very many organizations are mature in the scaling of AI. And a major part of it is a lack of trust, especially from a customer perspective, but also a lack of trust and buy-in from within the organization. And the big part of that is failure to address what are we going to do? And it's a question you fairly get. And this involves thinking about the social implication. Having said that, there's certain initiatives that leaders have to keep in mind. Number one is, how are you training and preparing people for the future that is already here? Now, we always say it's very dangerous to just focus on efficiencies or productivity. Out of every use case as a leader, you need to ask very tough, measurable questions. What could go wrong? How are you preparing people to work in a world where AI is in relation with that use case? For example, Loizi talked about automating some of the processes, like, for example, fraud identification processes. Now, a fraud investigator today will now be working with a technology that has done all the manual work. How do you redefine their role? And it must be clear, because the statement, "Oh, we're going to repurpose you," is normally vague, right? So you have to prepare people in a tangible way. But you also have to prepare people to feel accountable for it, including the risks that come with it. We're talking about unintended consequences as well as the cost of things going wrong. I think people feel wholesomely accountable when you look at the positive side, the opportunity side, as well as what could go wrong. The other part is drive inclusive strategies. I think the mistakes people make is you actually need your frontline staff to use AI. It's not a board conversation alone and data scientist conversation. It's everyone's conversation, because the value of AI will come if the frontline integrate the use of AI. So training, accountability, and inclusive running of the strategy, and making sure you prepare your people so that they can take part. The emerging risks are presenting lots of opportunities. The ethics space.
Yeah.
And we don't have to get new people to do that. People who understand the way an organization creates value can play a role if they're supported very well.
All right. You've heard it, no? You've heard it. You are not going anywhere. AI needs you too. All right? It needs you too. I want to squeeze a moment on before we go to Q&A. It's quite interesting that you're talking about we need to humanize adoption. And I was having a conversation as part of this prep with Ayanda, and he mentioned a phenomenon that I thought is so interesting, we've got to bring it in. You were talking about we need to dehumanize AI and human oversight. I'm like, huh? Because AI, the excitement around AI is its ability to do the things that me and you can do. And here he's bringing up a phenomenon around dehumanizing it. And when he broke it down, it made sense. Let's hear you.
Hopefully I can make sense again.
But why is there a need for that? And why is it such an important phenomenon that we need to start bringing into the conversation?
Yeah, I think we need to design to augment what we do as humans from get-go. And that is why, we call it co-pilot in terms of driving increase in productivity. It's your assistant. So AI is there to help you. It's there to help yourself as a human being, being more productive, to accomplish tasks faster. And that is why if we give AI human qualities, we're driving the fear that one day this thing is going to take our jobs away from us. But if we constantly amplify the fact that AI is there to augment what we do as humans, we're then driving a point that we're building technology that is here to help us scale as human beings, to help us to be able to get to more things faster, to compute things ordinarily that would taken us a very long time to do, and to do that. I'll give you a very simple use case, in financial services that are still getting more and more traction. Many credit agreements are now concluded over the phone, right? Whether you're subscribing for a cell phone contract or a loan, you do it on the phone. And according to regulations, the person that is conducting this, this product over the phone must maybe say these 6 things to you so that you understand your accountability, you end this and you said that, all of those things that they read to you when you're concluding a credit agreement, right? Now those calls are recorded and those calls are stored somewhere. Now, depending on the size of the organizations, there's thousands of these phone calls a day or a week or a month. And in order to audit them, we audit a sample, right? We don't go and listen to all 6,000 phone calls that were made in many instances. We take a sample and then we look at it and say, oh, this one could have a potential here. The agent forgot to tell this person, that this is their right? And then you begin to use that for training. What is starting to happen now is you taking the full volume of phone calls. At the end of that phone call, you transcribe that phone call from voice to text, right? Leveraging speech to text, which is a cognitive services, which is in AI. And then you store that as text somewhere. And then you use large language models to say, please give me all phone calls where somebody missed telling the customer Regulation 9. Now you are able to chat with phone call data in its entire population. You're now no longer just taking a sample. Give me the 10% of calls. I need to check them, right? You now begin to do that at scale, and we see this a lot. Something we could not do before. AI is now allowing us to do all of this. You can even implement a scorecard for each phone call, for example, based on the key things that are said in that particular call, and say, please give me all calls that have failed to get more than 80% on this scale, because you've built it as a bank or as an insurance company or as a regulator, if you have that oversight capability. All of a sudden, things that you used to take a sample for, you're now auditing the entire population, leveraging AI. For me, this is where AI comes in. So it's not replacing a person who's supposed to do their work. It's making them scale. And to Doc's earlier point, the decisions that we take as leaders in terms of saying, hey, I used to have 10 auditors, perhaps we could do it 6, all right? Are those the right decisions that leaders should take? Right, in terms of driving that? Or can we augment these skills elsewhere in the business and help us scale? The decisions we take as leaders after we get efficiencies is going to be key. Are we invested in this economy in order to help scale and drive things forward? Or are we looking for something quick to save as a cost, leveraging this AI? Those are the difficult questions that we should be asking. Now, Nonwazi mentioned earlier things around ethics and explainability. The big question that I always ask whenever I speak to Excos and speak to boards is, there is always an ethics committee in the board. Have we started to create capacity to people that serve in those committees to ask the right questions from executives when it comes to executing of AI projects, right? Do the people that serve in those committees have the ability to be able to ask those questions in order for us to move to drive accountability? You can't drive accountability if you don't know which questions to ask, right? So the development and skilling is not only in the tech teams, it's the entire organization.
Yeah, I think as a sector we have a really big responsibility on the question of trust, you know, creating that trust amongst our consumers. But as you've been listening here, it goes back to the decisions that we make. We can't submit ourselves totally to just technology leading us, but you've got to be conscious about the decisions that we make from the very first initiative that you want to undertake. I want to open the floor for questions. We not more, just 3 questions, not more. I can't see. There's a question in the front here. I can't see at the back, so I'll take the lead. Oh, I can see. Oh, and over there. So I have one there, one in the middle, and a lady over here.
Is this on?
Okay, please come through.
Hi. So I work for Moody's. So we have a partnership with Microsoft for Copilot, which is exciting. And I just wanted to ask, actually, the whole panel, with this new AI, how do you ensure the client data is kept confidential with your large language models? How is it kept safe?
Okay, large language models and data privacy.
Hi, my name is Judith. I'm from APSA. Can we expect to see any regulation on AI in South Africa? And if so, how soon?
Okay.
Hi. Hello. My name is Erica, and I'd just like to ask, how can we use AI and ensure people don't use it for the wrong reasons? And what I'm trying to get to is, when we're collecting data, so and I'm just picking on you because you're from FNB, let's say you're collecting all my data and you want to see how fast I drive, so you monitor my driving, you want to see my medical because maybe you're going to sell me some medical insurance, you're going to ask me about how much I spend on my clothing, etc., but then use that to create products actually not to pay me. So when I'm driving fast and I've driven 62 kilometers an hour in a 60 zone and a truck comes and wipes me out, and then you go, oh, we can't pay them because they were driving 62, but a truck wiped me out. So a lot of the time right now, data is being used to entice us, or consumers or employers are enticing us to give them data by giving us all these free products or these free incentives to give them the data, but they're actually using it against us.
Yeah.
How are we going to try and stop that?
And they call it value add.
Value add.
Free of charge.
Value add.
Free of charge,
Free.
just for you.
I will give you a free watch if you tell me. But really what I'm doing is finding out
value
where you
add,
walk to.
that's the word.
That's for you.
Okay, who's going to take on the LLM one around data privacy?
Maybe let me take that and Doc takes the FNB one.
Yeah. Is that an FNB one? All right, you go, Ayanda.
And one of the things that, and maybe coming to one of the things that I say, if something is free, then you are the product.
Yes.
You must know, right?
Yep.
You are the product. And then coming back to the confidentiality of client information, because you want to expose these models to client data because you want to create value for client, whether you're using it for personalization. You want to be able to give a personalized service. There's one thing I hate for that a network provider calling me to upgrade my cell phone, and they have to ask me the questions. Like, no, you tell me, right? I've been making calls over the last 2 years. You should be telling me what to do, right? So we want, as consumers, we want personalized service. And we have to have this model consume this data in order to get to an outcome that is beneficial to both me as a consumer as well as you as a service provider. But I think it goes back to the fundamentals of data management and data governance. If you don't get your data fundamentals correctly in terms of who has access to that data, the data that needs to be anonymized, is it anonymized? To Nola's earlier point, can you reverse engineer that anonymized data so that it comes back and gives you what you see? Because there are tools, so you ought to be able to do that. When you anonymize your data, you must test it against reverse engineering. Yes? To make sure that you don't reverse engineer it and reveal what was intended to be anonymized before. And whatever, and it's starting to now reveal gaps in our governance processes. I've seen companies that go co-pilot and say, oh, we need to hold back simply because we didn't think before that we needed to guard against this because it was people that are looking for stuff. Now it's easy to look for stuff. Yes. Now you just tell it, hey, can I please see somebody's salary like this, right? You don't need to write a query, right? All of a sudden now we see that, oh, there are people that have access to more than they should. We're now starting to go back and do governance and in order to move forward. Data governance is super, super key.
So data governance it is. Doc, do you want to take the F&B one? the value add one? The freebie one?
Sure. Was that an F&B question?
Yes. I know it wasn't.
All right. So I think one is every organization must have a clear, defined strategy of what it wants to use data and AI for. And as part of defining requirements of the role data and AI will play, you also have to define things that could go wrong and things that must not be done. And some of it, we've talked about bias and things like that, but conduct is also very important. We know very well in a lot of financial services, including telcos as well as marketers sometimes are incentivized for wrong habits, sell more products, do this. That has to change because if you're now going to automate things and your AI is going to be doing that function, you're basically putting the face of your organization's trust under scrutiny. So as part of the ideation of use cases, I talked about the AI canvas. Don't just define the amount of sales you're going to make or how much value. Define what things could go wrong from either bias, ethics, but also from a conduct perspective. But in some instances, we teach people design thinking because we want to test these approaches with a few customers first before going at scale with them. So if you're marketing products when you're using customers' data to market products, test with a few to understand how they feel about it, especially if you're using their data. There is no organization that designs something and goes at scale without testing it. And test it from a customer perspective. Don't just use your few staff employees to test initiatives because they will say yes. But get perspective from the consumer on how they feel about certain initiatives.
Yes. This is obviously quite a topical one. I'd like the regulator to just quickly say when. There was a question around,
Kathy.
yes, Kathy, a question around the mic over here. A question around regulation, Yes.
Can you hear me?
Yes, we can.
All right. Thanks very much, and it's a very good question. So I think first and foremost, we won't be regulating the technology, and I think that this is something which is consistent, will be a consistent approach as these new technologies emerge. Over time, we may be introducing or consider introducing tailored requirements responding to AI conduct risk. But I think what we are seeing is that even though the technology might be different, meaning different players in the space, and I think, we've got the sustainability panel next, and we'll start seeing similar themes between the digitalization and the sustainability. is that, so in the case of sustainability, we're having to get our head around new concepts like just transition and carbon neutrality and what have you. But at the end of the day, the conduct issues are the same. So we are talking about governance, we're talking about risk management, there are conflicts of interest, there's remuneration practices, there are incentives. And similarly, the consumer protection issues are the same. So we've got product suitability, transparency, disclosure, does the product do what it claims to do, etc. So if you've got AI sitting behind that, we're still going to be assessing against principles of fairness. And I think ultimately one of the constant themes that comes through as well is if for any entity, financial institution, if you are adopting these new technologies, that's good, innovation is good, but we've heard a lot of discussion around responsible innovation. And it will be very important to keep front of mind that you are still responsible for the outcomes of the practices that you're adopting. So even if you get an AI supplier who comes in, you can't then, and then it's found that it's leading to biases or prejudice or whatever the case might be, you can't claim, oh, that wasn't me. It is you. It's your business. You're rolling out these products. You're basing those based on these algorithms, etc. So yeah, I think ultimately the buck stops with you. And those are even within the current legal framework. Thanks.
Thank you, Kathy. I think thanks to everyone. If you forget anything that we've said here, just remember when you think AI, just make sure that you test for explainability, for transparency, for data privacy and accountability. Because at the end of the day, the conduct will be tested through those aspects as well. Thank you. You've been great. You didn't sleep. Thank you. Thanks to my panel.
Thank you, Pukeng. That was really, really great. Thank you, panelists.
Thank you.
Thank you.
Thank you so much. You know, when a subject hits close to home, you start taking it personally, and then you really want to know how all of this is going to affect you. QFNB situation over there. I felt that really deeply. But of everything that was said, and I know there were some really important things that came out, I know, Mahompi, you've got a point that you wanted to make. Was it a quick comment or was it a question? If it's a quick comment, please, I would like to allow it because I do think it would add to the conversation. So if we could just get a mic to Mahompi as the next panel gets ready. Do we have a roving mic anyway? Okay, it doesn't look like we do. Mahompi, we'll probably just take your point at a later stage then. One of the things that struck me in this conversation, and it had nothing to do with AI, when Ayanda said, when something is free, you are the product. The man made me evaluate all my life choices in that moment. All right, moving on, we're going to be talking sustainable finance. And right now I'd like to call to the stage Kirsha Singh, who is the head of our policy support unit or department at the FSCA. As per the last panel, we are going to have a short presentation and then she will call her panelists and moderator through to the stage. And that conversation will go on, including the Q&A for about an hour. All right, thank you so much. A round of applause.
Thanks so much and good afternoon. A really interesting panel that we're following. I remember when sustainable finance used to be the hot new topic. It seems that AI has taken its place. Nonetheless, I think you'll still find this a very interesting panel and discussion. I'm just going to be throwing forward actually to a publication that you can expect from the FSCA in the next few weeks, giving an update on what we're doing on our sustainable finance program of work. So we published last year this program of work that people have probably seen before, setting out 5 kind of key pillars that we're focusing on in relation to sustainable finance. I'm not going to go through all of them underpinned by capacity building, research and stakeholder engagement, and then considering where do we need to consider amending our regulatory and supervisory frameworks. and then coordination and cooperation with other stakeholders, which I think is a key theme for making sure we're doing things in a consistent way. You may be looking at this and thinking, well, what does this have to do with customer protection, which has come up as quite a big theme for today? And it actually ties quite nicely to what Kathy had just mentioned now in relation to in relation to AI. Because, you know, if you unpack it a little bit more, you find that actually the risks that are common to all financial products similarly apply to sustainable finance products. And the OECD has listed that, you know, similarly to traditional financial products where there are consumer risks associated with product design and quality, with inadequate or misleading information, market misconduct, low levels of financial literacy or understanding, and consumer biases or heuristics that affect how consumers interact with products. These things apply equally to sustainable finance products, and it shouldn't be seen as something completely new or out of the field of traditional financial regulation. Maybe one aspect that is pretty new, but even there I would say that this is a subset of misleading or inadequate disclosure, information disclosure. We've come across the term greenwashing, now speaking about social washing and impact washing that are much more squarely within the realm of risks related to sustainable finance. What does that mean? And what it means is, I've got here on the right-hand side of the slide, the G20 OECD high-level principles on financial consumer protection. And these span the range from culture and governance, which we spoke about earlier, to product design, how products are sold, complaints handling and resolution. And you see that what's been added now as a cross-cutting theme are three areas: digitization, financial well-being, and sustainability. And really, or sustainable finance. What this means for these cross-cutting themes is, how do you consider financial consumer protection when considering sustainable finance? How does sustainable finance impact the implementation of these principles? The OECD recommends, amongst other things, that jurisdictions should adopt a coordinated and holistic approach to financial consumer protection that takes into account sustainable finance. And, you know, there's a combination of measures necessary. It's not one thing in isolation. Disclosure and transparency is important. Financial education is important. Product requirements, complaint handling, effective supervision and enforcement. The same things that apply in traditional financial consumer protection equally need to be considered when we consider the realm of sustainable finance. What does this mean for us and our program of work? We're considering through our program of work really how does sustainable finance affect the risks that we're overseeing? How can our existing mandate and requirements and powers respond to that? And in what instances may we need to develop new requirements to respond to particularly novel risks? What's very clearly emerged and is going to be the theme of this panel discussion is the need for a foundation of credible and clear information. As a market conduct regulator, we have quite a vital role to play in improving the availability of credible and consistent information in relation to sustainable finance. All pillars of our foundation, of our program of work are important, but they really rest on this foundation of the quality of available information. And this in turn depends on the quality and comparability of public disclosure and reporting in the sustainability space. Just to note two key developments, and again this will definitely come up in the panel, was the launch last year of the ISSB standards IFRS S1 and S2, which take quite a significant step towards a global baseline for financial sustainability reporting, and the PA, our sister regulator, issuing draft guidance on climate disclosures as well. So two of our pillars of work, one being the green finance taxonomy and the other being disclosures and reporting. On the green finance taxonomy, as I'm sure we're all aware, South Africa has a green finance taxonomy. As the Presidential Climate Commission noted in a report last year, one of their recommendations is that we need to encourage better adoption of this green finance taxonomy in South Africa. And within the FSCA, we've been undertaking a variety of training and capacity building workshops to better understand the green finance taxonomy, taxonomies in general, the South African taxonomy in particular. And we will continue to encourage the voluntary adoption of South Africa's green finance taxonomy as a really integral tool in South Africa's just transition. It's important for supporting not only domestic but international capital flows towards green projects. And there's been a lot of focus to demonstrate how aligned it is with things like the EU taxonomy, for example. And this taxonomy work should be seen as quite closely related to the work that we'll do on disclosure as well, including from a legal and regulatory analysis perspective. And one of the things we're considering is a survey to understand awareness and readiness in our sector in relation to adoption of the taxonomy. Corporate disclosure and reporting is one section of one element of the disclosure pillar. I've mentioned IFRS S1 and S2. South Africa generally is considering the full adoption of the ISSB standards, and we're participating in a number of reporting roundtables that have been hosted, including by the CIPC, which, as we know, regulates and oversees company requirements. We anticipate potentially releasing similar disclosure guidance to the PA's climate disclosure guidance, which, as you know, applies to banks and insurance companies. And looking at what makes sense to introduce to the broader sector as well. As colleagues are probably familiar, we do have Regulation 28 in the pension fund space that already speaks to ESG considerations. And so a first step may be guidance, stronger guidance in that sector. But just to make the point that, you know, we are going to be working in very close alignment with the Prudential Authority and not creating duplicative or inconsistent requirements on the industry that both of us oversee. And then another aspect of disclosure, obviously, is product and retail disclosure. And this is where risks of greenwashing need to be very particularly considered and addressed. It's very closely related to considerations around the green finance taxonomy and corporate disclosures, because that's where the baseline or bedrock of information comes that will tie through to how products are designed and marketed and sold. But obviously, product and retail disclosures also need to consider what level of information is provided depending on the customer to which the product is being provided and how that information is being provided. And just to note here, a very interesting point from a draft application paper issued by the IIS last year is that jurisdictions should consider to what extent new policies or regulations are required to address greenwashing versus whether existing requirements, and we do have this in South Africa, of providing fair and not misleading information and preventing mis-selling are actually sufficient and can be applied to this space as well. And then not to go into too much detail here, but just that there are other key focus areas. I think on this topic there's a lot to talk about and a lot to unpack. We're looking at where further research may be necessary to assess where there are market or regulatory barriers that may exist in relation to impeding investment flow that we could potentially be addressing or addressing in conjunction with other stakeholders. A big theme that is emerging is this issue of insurance protection gaps and who covers in the event of natural catastrophes and disasters. Are customers adequately protected and insured? What role is there for public players like the government to play in responding to these risks and the impacts that they have? And we're collaborating as well with industry to look at things like contract certainty for exclusions that could exacerbate protection gaps. There is a process underway on developing carbon credit markets in South Africa, and we are participating in that as well. And then looking how we develop clear and accessible consumer education materials on sustainable finance as well. So it was a very quick overview, and I think really emphasizing the importance of information in this space. With that, I would like to call on Kathy, the chair or the moderator for this next panel, and the other panel members to come onto stage. Thank you so much.
You do that. You didn't want to be picky in the middle.
Okay, please give me a thumbs up that you can hear me. help with the mic. Sounding better?
Yes.
Okay, great. All right, now, the earlier session, I was extremely cold. I'm glad that they have reduced the aircon a bit, but I brought back up just in case. But given that this is the sustainability panel, I think it's important that we are not draining our carbon resources unnecessarily. So we seem to be on track. I have somewhat of a wild panel, a bit unruly. So I may have, it's very structured, and I've got lots of very interesting questions, but I'm not sure if we're actually going to get to all of them. And I know that there are very strong advocates of, and very strong views in this panel, but that's great. Hopefully those will enrich the discussion completely, but please do bear with me. I'll do my best. I think we can start then with our introductions. So can we start on our left?
Afternoon, everyone. I'm Robert Lewenson. I head up Responsible Investment with Old Mutual Investment Group. It's really a privilege to be here today and to support FSCA in the work around sustainable finance and ensuring really a functioning and vibrant sustainable financial market that's going to enable flows of funds into and ensure that investors such as ourselves and myself personally feel comfortable and satisfied that the products that we sell actually do what they do. So thank you, Payne.
I'm Ann Cabot-Alitzhauser, and even I can't say my name, so don't worry if you can't. I don't know who came up with that name. Anyway, I'm adjunct faculty at Gordon Institute of Business Science, and I head up what's called the Responsible Finance Initiative. And not to be confused with what you do with responsible investing, but responsible finance, the beauty of being in the academic world is that I don't have to sell anything. I don't have to convince you to buy something. And so I almost characterize my job as being the one that says, if finance is going to be responsible, then it means that if I'm going to deploy it in this way, with this intention, then it can achieve that intention. So I'm sort of the bullshit detector.
As I said, I'm really passionate.
What? I didn't mean to say that. Did I mean to say that? I'm fasting. I'm not eating. But that's essentially what we can do in academia. It's a lot of fun.
Good afternoon, everyone. My name is Haida Obey, and I am the head of the department responsible for investment providers. So I regulate the asset management industry and the CIS industry.
Thank you. And then lastly, and I realize we've created an FSCA
corner.
Yes.
Maybe it's the protection against the sector.
Thanks, yes. So as Tembisa said, I head up the policy support department at the FSCA, and part of my responsibility is coordinating our work on sustainable finance. Thanks.
Okay, great. So now you know a bit more about all of this. And let's start with you being
The senior member on the team, is that what you were going to say?
I was going with maybe the most independent, but and just the theme of today's, or the topic of today's, is really a focus on reporting and disclosure. I mean, there's such a big depth of complexity in sustainability, but this is where we're going to at least try and focus some of the discussion. So Anne, from your side, does reporting on sustainability matters matter?
Absolutely. But it matters in a world where we've really understood economic theory differently than the way we may have understood it historically. We now understand that economics doesn't sit in a little bubble over here, but that bubble is surrounded by a world, a planetary boundary on one side, a societal boundary on another side, and therefore, if we can now start reporting on how that economic entity interacts and is interacted by the world around it, that is fantastic. That's knowledge we all need to have. So sustainability reporting is fantastic. You know there's going to be a but I'll get to the but later.
No, carry on, please.
No. Well, I think it's a great way to start. We can come back later.
So both Anne and Rob are in the sector, but they're wearing different hats, as you've already heard. What do you see as being the current state of reporting, sustainability reporting here in South Africa?
My current state is nascent, I would say.
Yeah.
We still have a long way to go. There's a lot that companies are doing voluntarily as a result of increased either activism or stewardship from financial institutions or NGOs to report.
That's good. Thanks. How are you?
On
good to see you too. Thank
that
you.
are material.
That's very nice. Oh, okay. Are you back tomorrow?
We seem to be
Are
getting
you
some
presenting tomorrow?
We're hearing somebody else. But somebody else is...
Right. Cheers.
AI is watching us.
That's what I said, but no one heard me. So use of this material and this information is crucial. For us, it really is used every day in terms of our investment decision-making process. It ensures that we are able to produce strong financial performance for our clients. Without this information, without being able to absorb it, to test it, and to put it back into the market and back to companies in terms of what they are disclosing, we are in desperate need of assurance that this information is as correct and as factual and as transparent as possible. So it has a direct role, just like any other information. We should not distinguish here between what is sustainable information and what is material information. Material information is relevant across the board, and just because it forms within a category of sustainability or ESG, I don't know the acronym.
Hate the word.
Please don't think of it as any different or any less pertinent to our investment decision-making process.
Great. And Anne, from your side, are we going to get the butt now?
No, I absolutely agree. I'm sitting there saying for corporates to be able to report on what they're doing is critical. The question then becomes, what do you do with that information? And I think, as Rob has said, it's just part and parcel of what an investment professional does. So the but comes to the regulator. To what extent does it get regulated? So disclosure should probably be regulated, what you disclose. What's concerning is that, and I was listening to that AI conversation very intently because there was really quite an interesting evolution of thinking. And it was amazing how fast the technology industry realized that if they didn't stop and think carefully about what they were doing, they might end up in a kind of a a dead end. And I think, in a way, our industry didn't enter into this whole sustainability arena with enough forethought. It didn't really ask the question, if I want to look at reporting on my ESG characteristics and submit that report to the FSCA, what's that going to mean? What does that actually mean? And should the FSCA regulate things like that? I know that when Olana was trying to contemplate how the pension fund industry should think about sustainability, they asked for the first round of submissions to sort of say, how are you treating this? How are you reporting in your own pension fund about sustainability? But what does that mean? And I think that is the lesson that a lot of us haven't really learned. I mean, I remember 15 years ago when I had to switch pension funds, being asked what investment I wanted to go into, and I said, well, obviously a passive ESG fund. It probably took me 10 more years before I realized that being in a passive ESG fund did absolutely nothing. It didn't change the world. Nothing happened. It just maybe increased my costs as a passive fund, but nothing was going to change in the world by me moving over into there. Now, you might dispute that, but this is where I'm coming at with the FSCA. So it's that if I'm offering you a product, is that product going to do anything that is being suggested by the label that I put on that product?
Yeah. So I think as the FSCA, I mean, well, there are a couple of points that have been raised. I think stewardship is one which we're still trying to get our heads around, and the extent that stewardship can be driving voluntary adoption as well. This question of what must be reported and to whom. And you know, we often are having these conversations around disclosure and reporting, and it tends to conflate sometimes between the corporate reporting vis-a-vis private disclosure, and then again the to who. Never mind what gets sent to us as the regulator. But we'll come back to some of those issues. Maito, from your side, you are the brave lady who is responsible for unpacking this for the FSCA, or one of those responsible for unpacking it with Kershaw as well. What are you seeing in your space?
Thank you, Kelly, for that. I don't know about being brave, but I guess I get to do my job. Kershaw spoke about, in her presentation, the statement that we published regarding sustainable finance in our work program. And because of that, internally at the organization, we had to establish various working groups that are looking at various pillars that are centered around our work program. And I guess because this is also important for us from a strategic objective perspective, so ESG, or sustainable finance, has been topical, and it continues to be topical. And there's a lot of work that we need to put as regulators. But I will just, before I get to talk about what we are seeing from a supervisory perspective, talk about some of the initiatives from the organizations that we have been doing, particularly around sustainable finance and supporting, obviously, the work program that we have. We've had various industry engagements, and some of those industry bodies are within the room, whereby we just wanted to gauge and understand the journey within various sectors and where they are heading when we are talking about sustainable finance or investments. And in our engagements, we are also trying to see what is the dialogue that we can start creating with our industry around this topic. And particularly now focusing on my sector, which is the investment provider sector, we also issued a survey on sustainable finance and investments. And the survey was broadly focusing on the role that the boards are playing, or the governance oversight rather, in terms of developing sustainable investment products. Disclosure is something that we are going to talk about a lot. Our survey was also looking at the disclosures, and you made such an important statement that you just chose a product that you wanted to invest in, but 10 years down the line, you didn't understand the disclosures. So basically, you didn't make an informed decision when you were getting into that product. So we are trying to see from that survey as well, what are the disclosures that our entities are putting out there to consumers, but particularly, do consumers understand what they are getting into in terms of the risks of the products, and do they understand that even though they might be advocating that they want a sustainable product or they want to invest into a sustainable product, but there are risks around that. So our survey is more focusing on the disclosure, the risks that are around these products, and particularly, do investors then understand to make an informed decision? And lastly, we also considered product design and development. And these are the considerations when you design these products. What are you thinking about? Is the end customer at the back of the mind of what you are doing when developing these products? However, what we are seeing in terms of the work that we are now doing, Kathy, to come to your question, is that we do believe that there is a lot of dialogue and engagement that we still need to do with our industry. Some of the entities we've been engaging with are even thinking that the regulator is far-reaching on this topic, but I mean, IOSCO has been quite topical on the issue of sustainability, particularly around the asset management industry. So what we are seeing is that there's a lot of work we need to do in engaging more and understanding the principles around this, particularly within our industry. And I think to develop an approach, it will be informed by the work that we are doing as a start. And also what we need to consider is that even though there are no hard line reporting requirements at this stage, but there's a lot of work that other bodies are doing. Kesha mentioned the ISB standards that entities need to comply with. So what we're seeing from our side is that there's a lot of conversation that we need to have. And lastly, there's a lot of alignment we will need to do.
Thank you. Yeah, so there are a couple of themes that I think we're going to see coming through, and one of those is kind of linking between the role of the financial sector and the corporate sector in general, their disclosure, reporting. I think the critical question is the why, because this isn't just around developing products. This is all around, or a lot of this is around the flow of capital, channeling capital to where it's needed to support a just transition. And so as a regulator, this makes it quite complicated for us, because now it's not just about managing consumer risks. It's also about ensuring that the sector is developing products not just for consumers, but really products that can drive this channeling of savings into where it's needed for infrastructure and the right kind of development. So this is now a market development question, not just around consumer risks. The JSE has issued guidance, disclosure guidance in 2022, and they've had some quite good feedback in terms of the take-up and the support for that, particularly around reducing the fragmentation in I suppose the standardization, supporting a standardization of reporting methodology. They did highlight some challenges that the industry is facing around skills and expertise in organizations, particularly around taxonomy. And interestingly as well, I think there's been some uncertainty in the corporate sector around the extent that this was compulsory or voluntary, and they made it very clear, or have been trying to make it clear, that at this point it is voluntary adoption. But it does just lend itself or show how we do need to be very clear on our expectations as the regulator within the sector. But within this context, Rob, if I can hand back to you, and if you can, as a company that has been voluntarily adopting sustainability approaches, practices, can you talk through some of your experience, especially in relating to corporate reporting and taxonomy? But I think you've got very interesting stories all around, so I'll give you carte blanche.
Thanks, Kathy, and I'm glad you can all hear me now. So, when it's been voluntary, we're very supportive of the JSC's guidance notice. Our biggest concern has already been raised that it wasn't made mandatory. The reason for that is that pretty much would have ensured that every listed issuer that we invest in on behalf of our clients would have been adopted and would have adopted a common standard around how they report around these particular issues on sustainability. That said, what we have seen is that even in voluntarily doing so, our big listed issuers who do have the capacity to a large extent are, and not only are big issuers, but there are those who are able to do it for capacity reasons, and there are those companies who want to do it because they realize how important it is to attract investor capital to be shareholders of their companies or debt providers. So what we would like to see, all of this happened, and then we get this global standard of convergence. IFRS took over a whole lot of fragmented reporting standards, some of which were voluntary, some of which were mandatory, put it all together and created this ISSB standard. Now, what this means for where we sit in is that actually, as good as the guidance notice was, it's almost been supplanted now. Because as soon as you have to report in your financials and have it assured independently by by the combined assurance framework, that information has to be, it provides a lot of comfort and transparency around what the companies actually have to disclose now. Now, you may say, well, South Africa hasn't adopted that standard. Well, in my experience, and have spoken to the chairs of audit committees and the boards of various companies, in many cases, our listed issuers have no choice but to adopt the ISSB standards for the very reason that they have subsidiaries in markets that have adopted the standard. So, again, voluntarily, but moving along the line, I'm very supportive of that, and I'm very supportive of any initiative that will allow us as a South African market to officially adopt the standard and roll it out in terms of our financial reporting. We do have a very strong financial reporting frameworks and adherence to IFRS and a strong auditing sector. So it almost stands to reason that these additional disclosures should give us comfort when we look at them and we look at the company, we look at the information, that they are assured at least that they are making sense, and there's been a third-party external provider looking at that information for us.
Just before we move away from it, we were talking a bit outside of, in preparation for this, about the US situation. Do we want to learn from them?
So I think we want to learn from all the experiences that the global regulators have had thus far. Because in the US, of course, a lot of that of what's been happening there has become very politicized. In the EU, though, there has been still, even though they are probably seen, and we see them as having the sort of the most advanced, or have taken the most advanced steps around the regulation of financial reporting and sustainability reporting. And we have adapted our own South African green finance taxonomy on the basis of the EU one, for example. They themselves are going through what it's called a teenage years of sustainability reporting. So in a sense, it's quite an appropriate time for FSCA and other regulators, South African regulators, to do this exercise, because we can learn about some of the mistakes that can happen and can creep in, some of the interference that can creep in, but ultimately what we're looking for is taking the best of what we've seen globally and trying to adapt it and make it appropriate for our local market, given our unique circumstances.
Can I ask a question? Does the FSCA have is there a mandate to tell companies what to report on? Does it fall within the ambit of their mandate?
Financial institutions.
Financial institutions, yes, but not all industry.
Listed entities to some extent.
All listed entities, but not unlisted entities, okay? That's just, I just want to get this clear, because, I mean, a lot of the, okay. I mean, I really admire the work that the JSE did. And what the JSE did is they made us very conscious that from a South African perspective, we needed, and I think it's for any country's perspective, we needed to understand not just how companies were going to be impacted by the environment and social factors and governance factors, but how they themselves were affecting the society around them. And that was that whole double materiality discussion. The problem that I have with the whole ISSB evolution is that it's been very much kind of following the path of least resistance, which is let's appease the corporates, let's do with the corporates what they want to do first. We'll get to the double materiality a little bit further down. We'll do an MOU with GRI. We'll try to incorporate this kind of thing. But we're still starting from a premise that puts the corporate very much in the way those early ESG funds that were dependent upon your ESG ratings, those were all on single materiality ratings. In other words, how they were being affected. We're now gradually evolving. You're right, we're growing up.
We need to, and because the next stage is, it was placed on the board. There's greenwashing, which will say you label a fund ESG, it does absolutely has no ESG credentials whatsoever. Then you've got social. We've seen many initiatives saying that they are socially inclusive or promote gender diversity, whatever the case may be. It doesn't include a group of companies or individuals even who have any of those characteristics. And what you're talking about, Anne, is around impact washing. Because we haven't yet, and I agree with you on this, we haven't yet been able to properly determine the impact of shifting 100 Rand into a sustainable product and having 100 Rands worth of value to society come out of that. And we need to get better at that.
I think we also need to help people understand what do they invest in that actually is going to move the dial.
Well, the best thing that will help them understand that is if we start talking about performance beyond financial performance of the product. So the value to society piece is something that we need. And I say this, we have funds that have linked themselves to the SDGs as an output. I know that they are, that they've labeled their funds as SDG, and they follow that framework, right? What's interesting for me, and what I think we need to go to in terms of what the outputs are, is, okay, so if we had invested 100 Rand into this product, we wanted to ensure, and as an investor, I have a personal belief around either transformation or gender diversity. I want to be able to track and measure that fund's performance in respect of that metric as part of the performance, in addition to the financial performance of that fund. And I think that's where we need to get some clear standards about what that looks like.
So I think it gets...
Sorry, I just need So, I'm so glad that you are witnessing this is actually the debate that's happening, and it is complex, and it does have all these different areas into it. But again, it's all around when we're talking about the impact, etc., which sits completely within what we've been talking around over the course of today. About outcomes, right? And in the case of these sustainability reporting or products, it's not about the product per se again, it's around we're actually needing to drive change that supports positive climate improvements or positive development, as we've set out these various priorities. Kirsha.
Yeah, so I just wanted to maybe respond a little bit to what Anne and Rob have been talking about, because I see these things as a continuum and not an either or.
Yeah.
And it's very much, we're sitting currently in a situation of an absolute alphabet soup of various standards and guidelines and benchmarks. And it's really hard to navigate. It's really hard to know which direction should I go in. And I take the point, and it seems now we're going at least the ISSB route from a single materiality financial reporting perspective. I don't think that should be seen as the end goal and the final step in the process, because you're right, that's very much about what are the impacts on the corporate and how are they addressing those. But that's very important information to have.
It's still important, yeah.
It's still very important information to have. And the minute we start talking about, claims that are being made, promises that are being made about the impact that this is going to have, where this is going to be delivering key outcomes, the regulator's radar goes up to say, well, are we sure that those claims are honest and credible? And that's where we need to start seeing how we play a role in setting those benchmarks and guidelines, but in a way that is also responsible. I was speaking to somebody outside about trends in the markets for sustainability-linked loans, which are apparently different to sustainability bonds for various legal contracting reasons. But that the market for this had declined dramatically because regulators were talking about regulating it. And now you're thinking about, well, what are the costs from really the costs of
making sure the information you're providing is honest and true. And it's a really difficult balancing act because you don't want to be restricting the growth of a market. You want it to be developing, but you also have to be making sure that it's happening responsibly. And so I see, you know, this being steps towards improving general information availability. That information availability is credible, it's consistent, it's clear, it's assured, that we need to start getting to. And then we can have the conversations about, well, how do we move that to new metrics about measuring impact? How much does a 100 Rand investment get you?
May I come in on that quickly?
I just wanted to, my 2 cents on this sustainability loans, and I'm not sure on the context and whether it was to corporates or to individuals. But I recently have been going through a process of trying to get a loan to go solo and whatnot. And I think just the complexity of navigating this environment is really hard to the point that we're reconsidering it because of all it's not, so for a loan, we've been offered a loan and then it gets marketed as being at a preferential interest rate. But then you get compelled to take up the credit insurance product, which is super expensive. And I think you land up seeing these kinds of, from the retail sector, but I think you would see it across the board. But let me hand it to you.
Well, I think you've spoken about a practical example which all of us are feeling. How do we live sustainably actually? And what is it the cost that we put into our sustainability journeys at home with ourselves, how we shop, how we act, whether we go off grid or not, or we're forced to go off grid or not? Is this going to have the positive change, the impact that we're hoping it will have in the market? In the world. And the point that I was going to make to both of you now is that this needs to happen quite urgently. Yeah. We really know that billions, if not trillions, of dollars has to flow into these sustainable investments in order for us to have any chance of limiting global warming to a 1.5 degree outcome by the end of the century. We know that it's not going to happen from the regulator or even from the state in terms of providing the capital. The capital can only be provided by the private sector at this stage. States' balance sheets are stretched beyond to breaking point from global financial crisis to COVID, etc. So the only way that funds are going to flow is if we ourselves as individual investors and large pools of investor capital flow into these sustainability-linked outcome products, let's call it that, for lack of a better word at this point.
So that's why I was asking what you could regulate in terms, and I think if there's any part of the market that needs to be developed, it's the part that allows products like this to be on the listed space. It can be invested in and measured in and of themselves. But, you know, I have to go back to the sort of mindset that people have that if I really want to change the world, I change the world by my actions as a consumer, not by my actions as an investor. And if I'm a retail guy, because I don't have the means to change the world by, you know, being in an ESG fund. Flip that around, and let's talk about long-term savings, the so-called patient capital that's no longer patient now that we're all defined contribution funds. Well, except for the big boys. Girls, they're almost girls. One girl, one boy. And, you know, you have to ask the question, you've got a whole world out there of how those funds operate right from the top of the asset liability modeling, where you have to be able to have an asset class here that you can identify enough of the risk return characteristics so you can say, well, what do I allocate of my risk budget into that particular product, even though it's identified as sustainable? How do I actually measure that to make that allocation? Because that's my responsibility up here. Because my first obligation is to replace an income that fund that's my first obligation. Now I know I fully believe in the Freshfields analysis that says what point is there making an extra 2% return on your pension fund if you have to retire into a world that's basically you know, environmentally unsound or burning up or whatever. I believe that. But the problem is, remember what an asset manager is doing. An asset manager is fundamentally buying low and selling high, buying the contrarian, not the good boys, buying the people that, you know, are, and that presents quite a problem in a very constrained market the way that we have here in terms of what your investment opportunities on the list of markets. So if we don't start finding ways to create products, and the regulators helping us create products that we can invest in that are listed, that can be, have some sort of oversight and be identified as being sustainable. I think by putting the whole fund behind the concept of sustainability, we've got a problem.
Yeah.
That's my view.
So it gets to the market development question again. What guidance are you giving to, are you giving any guidance at this point to your regulated entities, our regulated entities? I mean, just on the back
separating yourself from.
Kathy, I feel you're throwing me under the bus. But before I get to that, I will answer in terms of the role and our mandate as a regulator to say, IOSCO last year, I think sometime last year, issued a paper talking about the need to create greater visibility for regulatory, or rather for regulations and supervision by regulators across the world, particularly for the asset management industry. So I believe that all of us within the regulatory space, different things that we might be looking at, have a greater role to play around this topic of sustainable finance and investments. Kathy, to come to your question around guidance, it's quite difficult at this moment. And maybe instead of saying I would be giving guidance to the industry, I will say we are inviting the industry to continue the conversation that we are having. We understand that there is a lot that is happening around this topic. There are various standards that have been issued. There's quite a lot that we probably need to align. And for me, the reason why I'm saying we are inviting the industry to continue to have this conversation with us is, for us, it's quite important that we are properly aligned. Kesia spoke about the standards, rather the guidance that the PA issued for the banks and insurers, and the guidance that we intend to issue for our regulated entities. And with this, there's a lot of work that we need to do in order to ensure that there's no duplication of efforts and that there is alignment. And obviously, inviting the industry to continue to have this conversation with us is because they are at the ground and they are doing the work in terms of these products that they are developing. So it's quite important for us to understand what could be the challenges when we are developing our supervisory framework.
Yeah, we've heard a lot about responsible innovation. Here we have a responsible regulator. All right, so I think we have come towards the end of our discussion.
We just started.
But we are going to open up for questions. So please use this platform. Okay, there's a question over at the back, and in the middle, and then on the side.
Hi, thank you for the opportunity to ask another question today. I think that it's fantastic that we're having these conversations around sustainable finance and the reporting around it. And I think we just need to bear in mind that as the younger generations come through and you know, they start to question things and say, what are you, and I'm referring specifically to Gen Z, what are you as a financial services company or an investor doing to fund initiatives that actually will ensure sustainability of our planet. And they ask these questions not only from looking at what return am I going to get on my investment, but what impact are you making? And that may actually push the regulator into coming into that sphere, because I can go and complain to whoever the ombudsman is and say, my financial services provider said it's an ESG fund and it's promoting corporate social responsibility, but I'm not seeing that return on investment. So whether you like it or not, maybe the end consumer is actually going to be what drives us to rethink and relook how we disclose and report on sustainable finance. So it's just something to keep in mind, that it's no longer just about bang for my buck. It's also what impact does my buck make from a corporate, from a social and environmental perspective. So the push is coming. I really believe that.
Next is another. We'll take all three and then we'll respond.
Hi there, Ronald King. Just wanted to know, I do believe that, for example, if we look in the sustainable finance with regards to, say, for example, global warming, that there's very little doubt about the fact that that is a problem. My concern is that many of the things that are currently being offered as solutions will more than likely not be a solution and be more of a problem. So if we build anything, if the regulator is deciding on requiring certain disclosures or certain kinds of investments, we might well find out that the solution that we thought was ESG was more of a problem. I recently saw a beautiful picture of a car, an electric car, being charged by a diesel generator. And that to me was the epitome of where we currently are in many of the solutions that we have. So are we ensuring that we don't go down a line and then in a few years' time realize that what we did and what we required was actually more damaging than we currently have?
All right, and then one more. Thank you for that. It was down here, yes.
Thanks. I'm going to ask a question about carbon markets and buying carbon credits. Now, there's this big drive for carbon markets and buying carbon credits, but what does it help me to buy carbon credits for my conscience to say that I've now bought some credits when it doesn't help our own country and maybe it's doing something somewhere else and we can't measure it? So all these systems and all these carbon credits I can buy and all these things I can do, where do we actually see the difference it's going to make, and does it really make a difference? And who's ultimately going to make money out of it? Just investors, or is it going to have an impact on the market?
All right, thank you. So the way we're going to manage this, are there any other questions? Okay, speak now, or forever hold your peace. You can get all of us after the session as well. Closing thoughts, comments, inputs from my panel, please. I'm going to start on this side, and Kirsche.
You're pointing at Rob and looking.
Looking at you, but pointing at you. Keep you on your toes. Weiter. Rob.
Are we answering questions, or what are we doing?
It's your final comments.
Rapid.
You can respond if you like, and you can give any concluding remarks as well.
Okay.
Thanks. So I think, I really do agree with the point about saying that, consumer trends are really shifting towards understanding and being much more aware of the impact that we have in the societies we live in, and not just as individuals, but the products that we interact with, the services that we consume. And I think it's an undeniable imperative that we need to be living more sustainably if we want a future to retire in, to enjoy at the end of the day, and to leave behind for future generations. Maybe there are unintended consequences as we learn and grow, like charging electric cars with diesel generators. But I think there are also quite concrete facts, like the fact that we need to reduce carbon emissions. And
You know, these are things that if we can collectively harness information and action towards, I think it's the only way that we start making a difference. And again, I'm coming back to this foundation of credible and consistent information, because that's where the informed decisions can be made, and people, you know, really are voting with their feet in terms of what is acceptable and not acceptable in terms of the performance of various players in a society. Thanks.
From my side, what I would like to say is we are on a journey, and we are on a journey collectively. We cannot do it alone as a regulator. And I therefore invite the industry to be part of this journey that we are taking, because in terms of creating solutions that are out there for investors, we need to partake on this journey in understanding what you are doing, so that it also informs what we can do from our side, from a regulatory and supervisory perspective. In terms of investors becoming aware, are they aware enough in terms of the disclosures that are out there, or do we still need to build education around sustainable finance or sustainable investments? So this is not going away, unfortunately, and it is going to be here for quite a while. So I just want to invite you to take this journey with us. Thank you.
Thank you.
I will echo that and say that what we need is these discussions to be had. It's already been mentioned by one of our audience members. I think we need to get into the nitty-gritty and into the detail and grasp this nettle, really, so that we actually can create a fully functioning and vibrant and efficient market for sustainable finance. I believe it has to happen, and I'm very positive that it is happening. I believe that we are catching up, and in many ways have thought in some ways we know the goal we want to achieve, but we are making sure that in doing so that we are not creating the externalities that have been mentioned already. Just a quick comment on the Gen Zs about asking the right questions about their investing. We also know this: it's not going to be a differing discussion with the Gen Zs or millennials. Millennials, within the next 5 to 10 years, are going to receive the biggest transfer of wealth in the entire in history, in trillions of dollars, and is going to land directly into their laps, if you're lucky enough, I guess. But they are going to be the ones, they're going to be the gatekeepers of finance, and they're going to be the biggest investor group. So we need to be prepared for that eventuality that's coming very quickly down the line. And in terms of the questions that they're going to be asking of us as investment managers, we need to certainly be prepared. As regulators, we want to have those, we need to have those discussions. And finally, on the carbon credits, just quickly, it's a good question, but the onus is upon you to know that you are buying the carbon credit that attaches to a specific product. So, for example, I received a carbon credit, for an award. I thought, hey, that's great. I can travel up to Joburg for FSCA conference carbon neutral. But more importantly, I think I actually went and looked at each credit. It's tagged towards a specific vintage. And when you look at that vintage, it's tagged towards a specific project. When you look into that specific project, you can actually find that area on the map, what that project does. And if you know what, I actually went by and had a look to make sure for myself that this wasn't any kind of nonsense. So that kind of labeling and that kind of disclosure is going to be as important in the carbon trading market as it is in the corporate reporting or any other market for that matter. Thank you.
Oh, I don't need that. Just go and look up John Oliver's comments on the carbon credit market. Brilliant, brilliant stuff. Okay, 3 things. Here's a concern I have. We need capital in South Africa to help South Africa. And my biggest concern about having this great international sort of focus on climate change and what have you, is it hasn't matured to the point where it allows us to recognize that different players can play different roles. And the role we need to play in South Africa is very different in terms of dealing with climate change here than the role that, say, China has to play or the US has to play. And so we've entered into this phase where everything has to be uniform. And so if I have a plea to regulators, it's not to fall into the trap that we've lost recognition that we need to deploy capital ourselves to do things that help South Africa. The second thing is, I think, from the regulator point of view, is that what we've done as a society, and I'm, as a sector, financial services, not as a society, is that over the years, we have gradually pushed all the risk over to the consumer. If we look at how the financial services sector has impacted the US, it is now emerging to be the #1 factor in creating inequality in the US. But by virtue of the way that it has allowed risk to be deployed to people who simply aren't informed to do it. When we come around to these sustainability things, I don't think you're going to be able to tackle the issue of being able to tell whether that product delivers climate change. There's just too much work to do that. But there is a lot of work that could be done in terms of educating the consumer as to what can't be done by investing in public securities, publicly listed assets. Most of the JSE is multinationals anyway, the big ones that are invested in. So are you investing in ones that have high ratings there doing anything? It's hugely problematic. So there's a lot of education for the consumer in terms of seeing as we've given them all the risk, So those are my caveats.
All right. I think my panel has done a fantastic job this afternoon, this late afternoon. So please join me in thanking them.
Thanks. Yeah, okay. I'm good.
Thank you, Kathy. Thank you, Kirsha, and the other panelists. We couldn't agree more. Great job. Really engaging conversation.
Great insights as well. And one way to gauge how engaged we all are in the conversation is, one, in the room, to Pukeng's earlier point, no one fell asleep. I checked. But also online, to get to this time of day and still have hundreds of people still logged on, still asking questions and still commenting is really, really great. So thank you to our online audience as well. We see your great comments and lots of compliments as well, just to what's happening in the room and also how the panelists are really just digging deep into the topics. So at this point, we are down to our final presentation of the day. And I'm going to invite to the stage our Divisional Executive for Licensing and Business Center at the FSCA, Ms. Felicity Mabaso. And also just to mention, we've got the head of our licensing department at the FSCA also present in the room. He is going to join Felicity just after the presentation. Mr. Dikedzo Mashego will be here. So between the two of them, they'll be fielding questions from you. Thanks. Let's give Felicity a round of applause.
Thanks, Tembisa. Can you all hear me? Great. I'm very, very mindful that I'm standing between you and the mocktail. Is it cocktail or mocktail and or mocktail? So I just want to make sure. And I promise that I'll be a bit fast because this developing story, I think, deserves an update. And yeah, let's see how we do fast. 2 hours? Are we good? Kidding. We'll only take 30 minutes. And so I think it's common cause that crypto assets are a topical issue and a subject of interest for various stakeholders, including financial customers, financial institutions, and financial sector regulators. So, and it is a developing story, like I said, and the presentation today will focus on the feedback relating to the licensing of this new asset class. So we'll then look at the regulatory landscape for crypto asset service providers, and we'll then go through the stats and the progress to date relating to the licensing of this service providers, because I think this is an issue of interest that we've been receiving various queries on. And I think it's very important as well just to share with you some of the challenges that we have observed throughout the licensing process, and also, most importantly, to share with you some of the information relating to some of the business models that we have considered to date from various applicants, and some insights into the pre-licensing on-site visits that actually have been informed by some of the business models that we've looked at, and our approach to this pre-on-site visits, including the factors that we consider when we conduct these visits. And some queries that, actually lots of queries have been received by the FSCA regarding what the regulator is going to do regarding entities that have not applied for licenses. So we'll I'll touch a bit on that, and lastly, on the next steps. So the emergence of crypto and the growing popularity of crypto as an asset class, including the significant increase in the number of scams that have been reported relating to these assets or cryptos, the fraudulent crypto activities that have been positioned as legitimate investments, international trends, and the guidance and recommendations from by FATF have actually led to the declaration of crypto assets as a financial product in 2022. So what does this all mean? What did the declaration mean? What was the effect of this declaration? So from that date, it meant that any person who was rendering financial services activities relating to crypto asset needed to apply for a license. And in addition to that, there was recognition that people needed to get their house in order. Some of them have been performing these activities previously, so transitional arrangements were put in place, resulting in an application date of the 30th of November. But in addition to that, there was also an exemption that allowed people that were already in the industry to continue doing business. The most important information on this developing story. So, since the 1st of June 2023, we've received lots of applications. So a total of 355 applications have been received to date. And of the 355 applications received, 308 applications were received by the 30th of November, which was the deadline for the application process. And it means that all the 308 applicants that made sure that their submissions reached us by that deadline can continue doing business under the exemption that was granted with the declaration. And a total number of 47 applications were received from December to date. And we have approved 59 applications. So the approval is at the 12th of March 2024, which was yesterday. Believe me, we just didn't push it because we have a conference today. So our licensing meetings every second Tuesday, exactly on the Tuesday of the month. So it was bound to happen. So the applications were actually considered, and we have approved 59 applications. And the number of applications withdrawn is 34, and I'll talk to the 34 on my next slide. And the license applications, license applications withdrawn. And then the total number of applications in progress is 262. Just on the withdrawn licenses, I think the important point to make here is that the licensing process is intensive, it's robust, and at the same time it's consultative, and it's very important that we do communicate that, you know, there is always ongoing engagements with all the applicants. So each and every application that we've received, that we have assessed, has resulted in, you know, some form of engagements with the applicant. And what is good about this engagement is that, you know, there is guidance provided to various applicants, and advice to some extent. And the outcome of these engagements have resulted in, you know, applicants voluntarily withdrawing their submissions because of the acknowledgement that, you know, they may not or they don't meet the competence requirements. This is one of the key issues that we were faced with, where applicants do not have the required qualifications or experience to manage this new asset class activities. And then the second issue, you know, related to a lack of, you know, comprehensive business plans. I mean, if you don't have a comprehensive business plans, you know, we can't adequately assess whether your business, you know, has got the necessary plans or policies, processes, or procedures that is required to make the business sustainable, you know, from a governance perspective, and also financially sustainable as well. So, and also just what we've also observed is just a general lack of readiness to conduct the services. And, you know, as in, you know, when we sort of engage some other people, I think also there was that element of saying, you know, this is new. Maybe I've done it for myself, for my account, you know, and here's an opportunity for me to, you know, to try and see whether I can apply and then manage assets on behalf of or render advisory services or intermediary services relating to this new asset class. So these are the key and main reasons why applicants, after being engaged, withdrew their licenses. So during the processing of this license applications, we also consider business models. And some of the business models received and considered to date relates to advisory services, pure advisory services models, the business models for crypto asset exchanges, your crypto asset arbitrage services, payment gateways, tokenization models, provision of index-based products models, and crypto to fiat business models. So this is what we have considered to date through the various applications. So on the issue of the pre-licensing on-site visits, which is informed by the business models, when we reviewed the different submissions, and as with any license applications, application relating to any activity under the FACE Act, whether it's crypto asset or derivatives or anything, we assess the risk because each application exhibits different risks. And on the basis of that analysis, we decided on a risk-based approach to select 16 business models and subject them to pre-licensing on-site visits. And most of the business models are your non-traditional business model that did not fall within the ambit and scope of the FACE Act. And it was very important to test the submissions, against the day-to-day practices and business practices on the ground. So that's what informed this pre-licensing on-site visit. And not only that, but to also verify, the existence of what is stated in the various policies, frameworks that accompany the different applications. And also the approach is that we also test those processes and policies and controls to determine whether they are enough to ensure customer protection and seamless processes for customers to engage with the applicants, whether it be a platform, a trading platform, or your exchanges, or your digital custodial asset services. And factors that we consider during the pre-licensing process includes, your business models. So we take a deep dive into, looking at the products, the services, the distribution of the products, and the services of the applicants. And we also, test the, like I said, implement the existence and implementation of the key operational processes, policies, and procedures. Governance arrangements are also very, very critical to assess and, to test some of these things during the on-site visit and have meetings with the people that are serving in those various governance structures of the applicants. And we also have chats with the compliance teams on the risk and compliance management. And generally, we also, we request a walkthrough the systems and test, the business continuity plans against, the solutions that the applicants have. And also, most importantly, any contractual arrangements with clients and any outsourcing arrangements that they may have, the applicants may have with third parties. So, unauthorized business. So the previous speakers mentioned the collaboration that exists between the different regulatory authorities. So we've got an effective engagement model that ensures that we collaborate, and ensure that, at this point in time, we've got, eyes and ears everywhere. We understand what is happening, where that is happening relating to this unregistered business, activities related to unregistered business. So this slide, what this slide is mainly saying is that the message here is any entity out there that has not applied for a license before the 30th of November 2023 and continues with crypto asset activities or services will be investigated, and there will be consequences for the illegal activities. So we're currently engaging with our enforcement department on some of these reports that we're receiving on entities that continue to conduct business. And I'm sure there will be communication in due course regarding those investigations. And in addition to that, we have those crypto assets that were not in the FICE regulatory network that were required to register with the FIC as crypto asset service providers. And according to our records and to date, we have 81 FIC registered CASPs, and out of the 81, only 43 have applied for licenses. So engagement with the other entities, the 38 entities that have not applied for licenses, commenced late last year, and we will keep everyone updated through various platforms on the developments in this regard. And I'm looking at the time now. We now go into the next steps. So as indicated, we have to date approved 59 applications, and the communication to the relevant applicants will be sent out in due course. And once we have sent out communication and we've licensed them, the status have been updated, then we'll hand over those portfolios to our supervision team for ongoing supervision of this new asset class. And the last point, just to emphasize, the investigation process relating to those persons that are conducting unregistered or unauthorized activities will commence. And with that, I thank you very much. And 20 minutes for the presentations. It went very well, and not 2 hours. So I think I'll invite Dikezo to join me if there are any questions on the presentation. Thank you. So I've deliberately invited Dikezo. I said I'll do the simple part of presenting, and then he can take the bullets for me. That are coming out. Thanks.
So I suppose happy to take any questions.
We can. We're here to take questions.
Let's do that.
Hi, afternoon, generally. Just on the third slide that dealt with the withdrawals, where the reasons provided related to, for example, lack of operational readiness, etc. Just out of curiosity, are some of those relating to applicants that are already operating, or is it new applicants?
It's largely new entrants. Yeah. In fact, I think that's
it's the
that's what
majority.
we've seen.
It's almost all of them
Yeah,
are
I
new
think it's all of them.
applicants, not existing FSPs.
Okay.
In fact, it would be a concern if it was.
Yes, it
the
would
other
be.
way around. It would be a big concern. Yeah. Yeah. Yeah.
I think there was another question.
Somewhere here.
I think we touched this morning on the importance of financial literacy. I guess just given the volatility of the underlying assets from a crypto perspective, is there the same expectation associated with the crypto license from those providers?
Let's see if I get that correctly. So when we go through the licensing process with the applicants, naturally we discuss the products that they want to offer and services that they want to render. Some of them obviously have literacy and education programs attached to them. For clients and investors, we would go through that. Naturally, I think we've seen it with especially the exchanges, and largely the exchanges, they have that. So we would go through that. On the advisory type models or discretionary investment management side models, we don't see a lot of that coming out. I suppose it's purely because the wealth planning or financial planning processes, part of what they do inherently is, talk to their clients about risks and disclosures, the necessary things that they would need to disclose to clients on the product. On the asset management side, I think that the again, we haven't seen any literacy or education programs coming out of that space. But it's also probably because clients in that space are almost investment savvy to a point. And that's precisely why we don't have, at this point, collective investment schemes as an example. And those are retail products, for the retail market. We don't have those investing in cryptos at this point. So in the institutional space, clients there probably understand the risks there. But I think part of what we will do as ongoing, as part of our ongoing supervision processes is to establish exactly that. But I think we are also mindful of the fact that, especially on the asset management side, investment processes are informed by a number of things, market outlook, investment horizon, client risk tolerances and things like that. But there's also a process that they follow with the clients in that space. So I think, we've seen quite a lot of education coming out of the exchanges and the online trading platforms. Yeah, that's another space. And those are also largely retail focused. So it's understandable that you have that. Thanks.
Thank you. And providers would be required to comply with the FICE codes of conduct.
Yeah.
And there are codes of conduct relating to different categories of FSPs. They talk to disclosures. It's more transparency and understanding about, the products for clients and the suitability of the products for the specific clients. So through the ongoing supervision approach, that is what will be tested, whether the specific service providers comply with the relevant codes of conduct. Okay, that is applicable to their business. Thank you.
And I think in addition, also what we look at are the risk disclosure statements.
Yeah.
Those are important because they bring certain risks to the client's attention. So that we definitely have a look at. Yeah.
Hi, Felicity. Thank you so much. Lalani from the FPI. Just a question for clarification. So the scenario is this is a Cat 1 provider. They've been an FSP for many years. So my question is the process for this FSP, in other words, they've got everything that you've discussed, they've got it in place, no issue. All they want to do is they want to add 1.27, which is cryptos to their license, the same way they would add 1.8, which is shares, for instance. Is the process different to add, just to add 1.27 to your license versus maybe 1.8? The issue is not that they're a crypto asset provider. They just want to be in a position that when a consumer or client walks into the office to say, invest or don't invest in cryptos, you know, because it then borders on the fine line of actually being an advice. So the bottom line is, my question is the process to just add 1.8 versus, for instance, or 1.27 crypto assets versus 1.8 to your license, is the process different? Because the feedback I'm getting is that it appears to be different.
No, it isn't. So all applications that come through to us, the assessment process is pretty standard, but we recognize that an addition of a product by an existing FSP versus an FSP that's just coming in new, you know, you've got to apply some proportionality there, but also purely because one has been in existence, you know, has been through the process, has complied with certain requirements and continues to do so, and one's just coming in. But we will, as an example, be interested in, you know, the policies and existing policies and procedures that are in place that are now amended to incorporate the new product. The advice process might be the same, but we just want to see and understand how that's brought into their frameworks and policies and procedures and other documents, especially client-facing documents. So we test it. But the process is not necessarily the same as we would treat a new entrant coming in. If that addresses your question.
Yeah, I just wanted to know if adding crypto assets is different to adding shares, for instance. You know, is the process different if you want to add crypto assets to your Cat 1, for instance? Is that process different to adding shares to your Cat 1, for instance? And what I'm hearing is no.
No. The process should not be
it's exactly
different.
The same.
Yeah, it shouldn't be different.
Yeah.
Good afternoon.
I can't see anything.
Over here. Good afternoon. It's over here.
Oh,
right at the back in the blue dress.
Yes, I can see you.
I can see you.
Thanks for the opportunity just to ask a question. We spoke lots about, you know, crypto assets under the phase space, but under FSCA, I would just like to know FSCA's view. If a CIS hedge fund portfolio were to invest into an exchange-traded fund linked to crypto assets, what is FSCA's state or your view on that? Is it completely taboo? Can we consider it, seeing if you say the ETF is a listed ETF, is that acceptable? And in future, is there plans for regulations under that space or not? Thank you.
So I think...
okay, do you want to take it? I'm also looking at Kathy on that question, especially from a policy position perspective.
So we haven't got a formulated position at this point. You know, for regulated CISs and pension funds. So we haven't, there isn't a formulated position, but I think that is something that's being discussed currently. If you want to list an ETF, there are FMA implications because it's got to be listed on the exchange. You know, so there are policy discussions around that at the moment.
Sorry, just on that, so it's more like the portfolio investing into an ETF that has that kind of exposure. You know, there's investment managers approaching us as a Manco, and Currently I feel no, it's taboo, but I need a solid answer. There must be something that substantiates what I'm saying. Why am I saying no?
So if you think, so BN90 of CISCA has defined almost the universe for collective investment schemes and limits and guidelines. Crypto assets is not in there. So that would need to be looked at before any of these regulated funds can invest in. Similarly, on the pension fund side, it's exactly that with Reg 28, So at this point, a CIS fund, I'm not inclined to believing that it can do that. Investing in a product like that's crypto related.
Thank you. My name is Tenjo from ABSA. Last month I attended a FSCA roadshow on enforcement, and I learned for the first time about a concept called enforceable undertaking, which I believe was borrowed from the Australian regulator, where you sort of allow you will accept some remedial actions instead of an outright punitive sanction. My question is on the 38 that are registered with FIC, but not yet submitted their license applications with FSCA. To what extent will you consider that enforceable undertaking in the interest of promoting financial inclusion? So you help them along, because I can imagine that some of them think that, well, I'm registered with FIC, that should be okay. Will you work with them? Thanks.
So the simple answer to that, no. I wanted to say one cannot preempt the outcome of an investigation. And what decisions will be, yes. So that's what I wanted to say, because you don't know what form that investigation is going to take, and it may lead to that enforceable undertaking. So that's what I wanted to say. I hope I've represented you.
Thank you, Felicity, and thank you, ABSA, for actually listening at the roadshow. I really appreciate it. You even remember that I said we borrowed it from the Australians. Yes, so on enforceable undertakings, it is a very important tool for us, and generally speaking, and this will include crypto-related contraventions, it is only a suitable tool if certain prerequisites are there. And one of them is there must not be an element of dishonesty. Then you're not going to get an enforceable undertaking out of me. Also, just to clear it up, it's not instead of another sanction. We often combine an enforceable undertaking with a penalty, because there was a contravention after all, but it will not be a penalty that will sink the entity. So the first test will be, is the facts of this case of such a nature that we would like to see the entity, the regulated entity, survive, and or unregulated, unregistered at that stage. If the answer is yes, then we act accordingly. An enforceable undertaking is a really nice way to help that entity to regularize and then do better going forward. Of course, inclusion comes into it, there's no doubt, but as I say, there's a couple of things that's not going to work for us, and that's one of that is the dishonesty, fraud, serious misconduct, harm to clients. I mean, I've seen platform trading activities that's run very well, and the only problem is they don't have a license. Happy to regularize. I've seen platforms where it's run really badly, and clients are pushed into horrible situations, and there is absolutely no thinking into suitability, etc. Unlikely that entity is going to survive. So yes, that's always a possibility. And the funny thing about this, and this is something that's maybe important to mention, is that when I talk about an element of dishonesty, sometimes you have a case that you think we can help this person to regularize. But then how they interact with my enforcement team, that's where the dishonesty comes out. That's not going to work then. That is a different problem. Thank you.
Thanks, Sarah.
Thanks, Sarah. What's the question?
Thank you very much. I have a story to tell you. It's a small story, actually, before I ask my question. It happened a couple of years back that someone was kidnapped, and then the kidnappers requested that for the ransom, requested the ransom to be paid in crypto. And the person was outside of the borders of South Africa. So I'm just asking, do you have any form of relationship with people in our common monetary area, and then, or maybe other jurisdictions when it comes to crypto, so that maybe you can assist other government entities to enforce what is required of them when it comes to such crimes? Thank you.
Gerard, I'm going to defer to you.
Yeah.
So I'm not sure whether the response should be on the ransom or on the relationship with other regulatory authorities or regulatory authorities in other jurisdictions. Maybe that, not the ransom part.
Sorry, I'm not a young man anymore. Just recap that question for me. I'll do my best. Just summarize the question. I didn't catch the first part.
What happens when the perpetrators? Yes, yeah.
Outside South Africa. Oh.
Mm.
Oh, okay. Oh.
Yes, with other foreign regulators and other foreign jurisdictions.
Not at all. We don't speak to anybody. No. No, we've realized for a very long time that we can't be isolated in South Africa if we want to do investigations and enforcement. So we are signatories to something called the Multilateral Memorandum of Understanding, and I think some 92 bilateral MOUs that Kersha is responsible for. And in terms of those instruments, we are obligated to assist foreign regulators with their investigations in South Africa and vice versa. So this is quite an active part of our investigation process, and it's quite a useful tool for my team, because the days are gone when you have this neat little case that happens only in Pretoria. And this works very well. It takes time, though. It's a long process when you have to go through those protocols, but it works very well. So we can reach across borders, and we can get the information. It's gone so far, to give an example, that in one of our cases, the Americans invited my investigator over, created the environment for him to do the interview under oath, and provided him with local counsel to assist him. So it's really great cooperation. There is one issue with it, and that's the Viceroy case that you might know about. We imposed a 50 million rand fine on Viceroy because of false information they spread in South Africa. You might recall that it was Capitec that was the victim. And we imposed that penalty, and on reconsideration at the tribunal said, no, you cannot reach across borders to impose such a penalty. We're taking that on appeal, because we believe there's an argument to say that this activity was in South Africa, and therefore we have jurisdiction. It's an issue about jurisdiction on the person and jurisdiction on the activity, which I'm not going to try and explain now, but happy to talk to you about it afterwards. We had a minority judgment in that case that we believe is right, of course, and that's the issue we will push. Thank you.
Thanks, Sarah.
Maybe.
Yeah. Is it all the questions? Okay. Thank you very much for, yeah, I think I've made it. Okay. So we can have a session.
Wow, we made it. This was such a fantastic session. We made it to mocktail o'clock. Thank you so much, Felicity and DK. Thank you, Gerard, for also stepping in. Really, really great conversation. A couple of things before we kick our shoes off
and put on our dancing shoes because we have a live band outside in the foyer there. We've got, is the live link still streaming? So I can start telling the truth. They say we are still streaming, so mocktails outside. Couple of things to just mention. All of the presentations that we had here today have been uploaded on the FSCA website. Please go and find them there if you would like to just really dive deeper into that. And also, you may have noticed that we've got cameramen around taking pictures. So I've seen some of the pictures, beautiful by the way. Mwah, you guys are just looking fantastic. So they are taking those pictures at the end of the conference on Friday morning. When we say thank you to you, we will send you that link to all of the pictures so you can see yourself. Thank you, everybody. Let's step outside to the foyer on my right, and let's enjoy ourselves. Really looking forward to connecting with you. One more thing to just quickly mention. Tomorrow's breakfast session is a closed session, so it's just for a select few people that will be engaging with some of the African regulators. The plenary session starts at 9 a.m. sharp. Thank you.